Setting up my YouTube. Dwight, is Ohio Eastern time frame? I don't know. I'm so not good with the time zones. But your clock sounds like it's in line with my clock on Eastern. Excuse me one second. My apologies there. The allergy situation is real here in Dallas, Texas. Welcome. Glad to have you guys here. David H., Miss Debbie. Miss Debbie, you've been awful quiet lately. Grant, Jas, welcome to the room. Nice to have you here. Bob L., Miss Adriana, Jay Roth, good to see you in here. Haji, Ron, Joel. Hey, Ron, I'm going to need you to check with me before you take days off. You can't just no-show, man, hanging out on the beach. That's not a way to live life. It's good to see you guys in here this morning. Buenos dias, Adriana. All right, so what are we going to do today? What do you guys think? Should we talk about patterns? Should we talk about advantages? I feel like we should become chart readers today, guys. Yeah, I agree, Ron. I'm going to finish up with you kids today and go swing some golf clubs. It's supposed to be beautiful today. So I'm going to go put a hurting on some Titleists. First thing I do every morning, guys, I already said advantages once. So the first advantage that I give myself every day is I just wait for news. Like I look to see when news is going to come up, guys. I look for medium impact. I look for high impact. I just dropped the snow in western. Is that Maryland, Bob? MD? Good morning, Andy. I should know that. Okay, gosh, you're way up there in Maryland. You guys can have the snow. It's 36 right now. I think we're supposed to get up to like 75 and sunny today. Yeah, it's beautiful. Yesterday was gorgeous. A little chilly with the breeze, but not too bad. So, guys, I'm looking for medium impact. I'm looking for high impact. And I'm doing it not because I trade the news releases, guys. I couldn't care less what they say. But anytime I see that or one of those, ooh, that's tiny. Let's make that bigger. I don't want to stress your eyes. There is more likely than not some Yahoo with deep pockets who will make a decision based on news. I don't want to be in this Yahoo's way. Oh, let's make that possessive. There we go. The 2 o'clock matinee tomorrow should be a fun ride. Yeah, that's going to be a good one. The FOMC, all that stuff. Guys, news also lets me know. So, for example, tomorrow is Wednesday, and at 10:30 a.m. it's going to be crude oil inventories. Because I know that it's going to be crude oil inventories, I also fully understand that an hour or so before it, there might be a bunch of people jockeying for position, anticipating what the news is going to be. You see it almost every day that there's crude oil inventories. You see that little shuffle and a lack of follow through. So by seeing this over and over, what it does is it creates a pattern in my mind, and it lets me know maybe crude oil is a quick profit day on Wednesdays until they sort things out. At 2 p.m., there's going to be the federal funds rate, the FOMC economic projections, FOMC statement, FOMC press conference. Trading goes one of two ways on FOMC days. It's either awesome and life is great, or it's the most erratic, range-bound day that you've ever seen in your life. So, knowing that there's FOMC day allows me to say to myself, I need to be hyper aware of rule number 2 on these termination conditions. I need to be very adamant about making sure that my rules are met. I am, Andy. I don't trade any foreign markets. If you were trading the yen or even the Canadian dollar, it would probably be a good idea to check the Japanese news, right? If you were trading the Australian dollar, you'd want to make sure that there's not something down under that could create problems. But since the only thing that we really talk about in here is crude oil, the NASDAQ, the S&P, guys, I even opened a gold chart today because the patterns that we teach happen on everything. And I know that I've got gold traders in here, so why not bring one up today? But yeah, I'm checking the US. And one of the things that you guys can do is there's a filter here. So you can get rid of all those other countries. You can get rid of even low impact if you wanted to, and make sure that you only have those ones that may be problematic for you. Good morning, JW. And then, ladies and gentlemen, everything that I talk about each and every day, and it's the same thing every day. It really is. One of the things that's true about Nexgen is that we don't have to change it every day. I'm not concerned with keeping your interest with new and exciting things, guys. I'm excited about building your knowledge base with the same thing, repetition every day, making sure that you recognize all these patterns. And everything that I talk about comes from the education page, the tutorial section. And the first thing that I want to do is I want to go to the glossary of common terms. If you are brand new to Nexgen, welcome. Great to have you. This is your classroom, not my classroom. But a lot of the terms that you're going to hear in the materials, a lot of stuff you're going to hear in the class, one-to-ones, divergence, reversal bar markers, bingo, TTFM, that's a great one. Guys, all of these, go through, scroll through it, check it out. Know what we're talking about. But what we're going to talk about for the first hour, and I speak about this every first hour, guys, is the high probability trend trade. And this is a trade where each indicator on every chart agrees for the rules of the trade. Agrees for the rules for the trade. Typically, this is when the triggers are their strongest, when there's nothing, no termination conditions exist. There's no trouble spots between your entry and your target. Guys, this is the best of the best. This is exactly what the new user needs. This is what we focus on for an hour, because what it does for you, and here we go, we're going to start the slideshow. Good morning, Cav. Is it turns you into a chart reader. You can want to be a day trader all you want. You can tell everybody, I'm a day trader now, and day trading is what I do, and day trading is my thing, and my thing is in fact day trading. But the reality is, guys, is you need to be a chart reader, because successful day traders can read their charts. They can take their indicators and understand whether or not they have a statistical advantage each and every time they place a trade. And chart reading will be about 90% of your day, I promise you. Chart reading will be 90% of your day, looking at your indicators and waiting for advantages. But once you're proficient at chart reading, like once you can do it, you're going to understand a few key concepts. You're going to understand where the market is likely to continue. This continuation point is going to be your entry for that highest probability trend trade. You're going to understand where the market is likely to go eventually, and you're going to start using that for targets. You're going to say to yourself, man, I've got key Fibonacci areas in the distance and tons of momentum. Why don't I go ahead and hold this trade a little longer? But then you're also going to understand where the market is likely to stop. And these likely to stop areas are what we call termination conditions. I cannot overstate the importance of understanding this concept, because likely to stop areas can kill a trend. Likely to stop areas are where the people who are in charge, and just a little FYI, it's not you or I, you or me, we are not making the market move, but the people that do react to these likely to stop areas, the market can reverse on these likely to stop areas. And even the market can create these big, ugly, untradeable fights at these likely to stop areas. Hey, good morning, Zorro. Nice to see you. So we're going to focus heavily in the first hour on just becoming a chart reader, understanding a few advantages, putting them together to turn it into a trade. And that's where the second part comes in, guys. Trade entry precision. You will be awestruck and amazed, guaranteed, when you realize how efficiently you can pinpoint where the market is most likely to continue. We're going to focus heavily on this. We do it because it allows you to reduce your risk dramatically. It allows you to increase your profit potential exponentially. So before we ever talk about trade management, we focus on trade entry precision based on the chart reading. And then once we're in at the best of the best spot, that's where you guys are going to learn to manage. You're going to use your ability to read a chart to understand where the market is likely to go or likely to stop. And this is going to help you put together a management plan. But the talk we have every day, guys, the most important thing that you can do in your educational journey is post in the room. It says post your trades in class. I don't just want your trades in class. If you pull up a chart and you take a picture of it, you may be asking about advantages. You can ask about really anything. You can ask about what we're seeing, which direction it's going. Is there momentum? Have I reached one of those likely to stop areas? Take a picture, drop it in the room. And I can tell you through experience that the people that post the most get to where they want to be the fastest. So post everything. But if you post a trade in class, guys, it's imperative that you share your chart read with me. It's imperative that you tell me what you saw that made you do what you do. And I want to see where you get in and where you get out. Because what I'm going to do for you is I'm going to give you feedback on everything that you see. Because remember, we're becoming chart readers. So if there's a challenge with your chart read, then we're going to discuss it. We're going to go back to the learning materials. We're going to identify where the challenge is and get you some clarification. And what we're going to do is we're going to do this every day. And I promise you're going to get so tired of me telling you don't trade indeterminations or your momentum wasn't there or that's one of those 50-50 trades with divergence that it will stick and you will progress. But the more you post in, the more opportunities you give me to look at your charts, the quicker you're going to get to where you want to be. And then the second one is look at the spreadsheet, guys. The spreadsheet was given to you by Nexgen when you downloaded the software. It's in the Nexgen Study Picks. I share mine every morning. There it is in the chat box right there. You can download it. And I give this to you because there's three really important parts to it. There's the first tab, which says copy of my tracking, guys. This is your live trades. This is everything that you're doing in the market. Every time you pull the trigger. And this isn't meant to create work for you, right? Oh, I just wanted to be a day trader. I didn't want to have to actually do anything. Every morning, guys, you're gonna put your trades in there. So Grant posted a picture in the room. It's a trade that he took. So Grant is going to drop that in here, and he's going to talk about how he felt and what he did and what the advantages were. And then there's a notes section that allows him to put in there. When Grant and I talk about his picture, and Grant, I'm going to pull you up and put you on the spot here. Grant says that he took a buy on a bounce at a support line. Large chart showed slowing momentum, but clear path for another 30 ticks. And we're going to say, well, Grant, absolutely. Your momentum is slowing, but your path is clear. You did have two divergences, but you do have an area inside of favorable large triggers, and you were taken out for a loss. How come? Because two divergences and weak triggers is likely to push the market down. So Grant and I get to have this great conversation about what I see, what he saw, and what may have gone against him. And he said, place the stop loss just below the support line. Beautiful. Taken out for a loss. Second divergence printed after I had entered the trade. And this is where I would tell Grant, and guys, this is such a great example of chart reading, is Grant, you were so focused on getting into the trade that you missed the fact that that divergence printed on the third bar down. You still had 2 or 3 bars before it got you, but it did print. But your attention was so focused here that you missed here. And this is just how the software works, and I know that, and I see this a lot, and I used to do it myself, is I would miss the big picture once I zoomed in on a trade. Once I decided I'm going to take a trade, I would lose sight if there was any change. And that's one of the things where when we have the conversation, we can talk about what worked and what didn't work. So when Grant looks at this picture tomorrow, He's going to say, I did have a clear path, and that helps me all the time. But what didn't work was two divergences with weak triggers. There was too much momentum going away to feel like that market was going to continue up. And that's going to be in his notes section. And tomorrow, when he looks for that long trade with weak triggers and two divergences, he's going to say to himself, I need some level of confirmation before I risk my money on this one. You'll find that the rules being met feels easy. It keeps you relaxed. You'll also find that when you knowingly break your rules, and this is one of those times where your annotations pay huge dividends, because you'll say weak triggers, but, or you'll say termination, but, and your language on the chart will clue you into the fact that you know you're breaking your rules. And that's okay. Once you're good at your rules, you'll know when to bend them. But as a brand new user, we want to stay focused on what works and what doesn't work. And you want to repeat what works, and then we want to work together to eliminate the things that may be stealing success from you. But this little study each morning, guys, it's going to prepare you for the day. It is going to accelerate your learning, but it's not going to pay dividends if you don't use the spreadsheet, if you don't annotate your charts, if you don't go back and study them. When you do find a trade that's the best of the best, you're going to drop it into your personal trade setups. Look, and this is you building your plan. I'm going to give you a rock solid plan today. But eventually your ability to read your charts is going to have you developing your own plan. So every time it is the best of the best for you. Like this one says perfect long. What does that mean? Well, that means that there was odds favorable momentum, and we're going to talk about this. And it meant that there was nothing in the way, and it meant that there was a pullback right to an area inside of favorable large triggers. And guys, this is the trade that we're talking about this morning. This is the best of the best. That's the trade that typically wins 70 to 80% of the time. That's the trade that creates an awful lot of confidence through the memory of success. And then finally, there is the third tab to the spreadsheet, and I would encourage you guys to go through and click on these links because it's about 300 pictures of you guys being brilliant with the software. It's about 300 pictures of momentum taking you for the win, of great entries creating manageable trades, of termination conditions stopping the market cold. And there's also a whole section on NASDAQ. I had somebody text me this morning or message me this morning and said, Mark, I just got run over. So what I did is I sent them my spreadsheet and I said, you need to go through the NASDAQ section. I blew out a ton of accounts so that you guys wouldn't have to. And a lot of my teaching comes from the mistakes that I made and the lessons that I learned. Adriana, I wasn't going to call you out. But small triggers against the trade when you get to the area typically run your butt over. So if you go back and you're a NASDAQ trader and you're finding, man, I keep losing these trend trades, Adriana, that's exactly what got you. And what it does is it creates this patience, waiting for it to be perfect, because now you've got something that's stealing your advantages, and you can visualize it, you can see it, and you can make sure that you don't repeat it. So there's ideas on management, patterns that repeat themselves, termination conditions. Guys, all of this is in the spreadsheet for you. The only way the spreadsheet doesn't work is if you don't use it. I know, because I didn't use it when I started with the software. We're going to take an hour or so, and we're going to learn the trigger line of Fibonacci rules for when it's okay to trade. We're going to talk about the high probability trend trade in detail. We're going to look at what the rules look like on your charts, where to find them. We're going to go find examples of it in the live market. And guys, if you have a question as I go through the rules, it's imperative that you raise your hand, that you ask. Because one of the things that you'll find is that the average user will listen to the lecture, will look at the rules, and then they find themselves trading in half-truths. They find themselves almost with the rules met, but they've convinced themselves that it's solid, that it's good. Posting your trades in the room, guys, that's going to help me understand if you are, in fact, using the lessons. I want you guys to simulate. Post your pictures in class. Guys, tell me what you did every time. Talk about where you're coming from and what you saw and what was there, and even tell me how you felt. And then we'll use your chart read, and we'll talk about how this termination condition knocked you right out of your winner. And you guys are going to be able to know exactly what that looks like in real life because we're going to simplify. You're going to stay focused, and you're going to know exactly what looks you're going to commit to, guys. You're going to learn the trigger looks, the Fibonacci and trigger looks so that they become easy. This is that repetition piece, guys. This is where the more pictures you take, the slower the market appears to move. The more pictures you take and annotate, the easier it is to recognize the advantages that tell you that it's time to take a trade. And this is what we're going to do today. We're just going to focus on that high probability trend trade. And we're going to talk about it because it's only got 3 rules, and simplicity is a wonderful way to stay focused on the advantages. So the high probability trend trade is a trade with only 3 rules, and each rule provides an advantage. And a trade is the 3 advantages put together, guys. A high probability trend trade is 3 advantages coming together to provide you the most amazing trade that you can take as a brand new user, the trade that typically wins 70 to 80% of the time, the trade that creates confidence through the memory of success, the trade that teaches you to become a chart reader. And the great thing is that you'll also understand when one of those advantages is gone, when your statistical advantage decreases, and you can go from a high probability trend trade to a medium probability trend trade when you still recognize 2 of the advantages. And we're going to talk about both of those. We're going to talk about a high probability first, and your ability to read charts will open the door for more medium probability scenarios. But each rule, rule 1 is going to give me the advantage of momentum. Rule 2 will give me a clear path. And rule 3 is going to pinpoint with pretty amazing accuracy where the market is likely to continue. And that's the one that gives me the advantage of an entry point. So these 3 rules, only 2 charts. So you're going to say, but Mark, sometimes I see you post 3 charts. But Mark, I see John Novak posting 4 charts. But Mark, guys, keep it simple for a little bit. 2 charts is all you need. Actually, on the large chart, you need 1 bar. 1 bar on the large chart, the most current bar, will define the direction, the momentum, and the areas on the large chart. And this is a very broad stroke of a brush, guys. Your large chart is a slow-moving chart. It's a freight train rambling on down the line. And it shows the overall opinion of the market. And the easiest way to say that is your large chart is the large crowd, the people that have the money, that move the market, that create the trends, that establish the momentum. These are the people that react to these key areas that you're going to know about long before you ever get to. The large crowd wins, guys. The large crowd is who we don't fight. The large crowd is this big angry shark, and he's going to make things happen, and we're going to be remores. And it's a pretty cool marine biology analogy here, guys. We're going to swim along, and we're going to let this guy fight the current. We're going to let this guy do the hunt. We're going to let this guy catch the prey, and then we're just going to take a bite. And we're going to take a few small bites a day, and we're going to reach our goals because we're never going to fight that shark. We're never going to try to be the first one in the market. That's him right there going down the gullet. So the large chart is the large crowd. The small chart is the small crowd. We're going to take this 1 bar on the large chart, and we're going to refine it down to 15 to 30 bars on the small chart. We're going to be able to see the movement within, if you will. And that allows us to refine the broad stroke. We're going to pinpoint where the market is most likely to continue. Rule number 3 is going to happen on this chart after rules 1 and 2 give us both momentum and a clear path on the large chart. And guys, reducing risk and increasing profit potential is the easiest way to get to where you want to be. So our first hour focuses heavily on getting in at the right spot, understanding that a trade is not your desire to make money, but rather the accumulation of 3 advantages. And the first one says that we need strong trigger lines. Rule number 1 says strong trigger lines. It's going to create the advantage of momentum. The only way that I can have strong trigger lines is if I'm trading with the direction of the market. I can't be in an uptrend when the background is green and have momentum to the downside. I can't be in a downtrend when the background is red and have momentum to the upside. So what I'm going to do is I'm going to go ahead and commit as a brand new user on day 1 to just following the trend, having that advantage. And then strong triggers only happens if the trigger line colors match the background. Both trigger line colors, the small triggers, these solid lines, and the large triggers, these dashed lines. For those of you that need to know how the clock is built, trigger lines are nothing more than moving averages. And that's pretty much where I peak in my understanding of them. These are moving averages. These moving averages show momentum. And when the background is green, and the small triggers are green, and the large triggers are green, and they are wide and angled in the direction of that trend, this lets me know once the separation between the small and the large happens, when the small get above the large. I always say in class, you should picture scissors opening. And the only way that you can cut paper is when your scissors are open. You can't do it with closed scissors. So that separation, that opening of the scissors is strong triggers. And when I have strong triggers, the odds are favorable for the market to continue up. So when the odds are favorable for the market to continue up, I'm going to buy Fibonacci support on a smaller, faster chart. It looks like a tail or a wick on these large charts. But remember, we're only using one bar, which means that I'm going to use that refinement chart to pinpoint exactly where that tail is most likely to form. We're going to use these tails to study, to go back historically and see the rules being true. But know that we don't take entries on a large chart. We don't trade the tails. We let the large chart establish momentum. Small's below the large are wide. The scissors are open. The odds are favorable for the market to continue down. Guys, this is the best of the best. This is when I'm going to sell Fibonacci resistance on a smaller, faster chart. Odds favorable momentum. You're going to hear it in the classroom all the time. Guys, this can break those key areas. Odds favorable momentum can cover mistakes. Odds favorable momentum shouldn't be ignored, because when you have the absolute best of the best, the market is likely to continue in the direction of the trend. But odds favorable momentum isn't a non-stop thing, guys. Remember that 90% of your day is reading indicators. And as a brand new user, it's okay to insist on these trigger lines being separated, wide, angled in the direction of the trend, because this is the best of the best. This is the highest chance of success for the new user, and what we're doing is we're trying to build confidence. And as the trend continues down, you'll notice both triggers stay down, but one line of the small triggers is inside of the large. This is the first sign that momentum is slowing. Visually, you'll be able to look at your chart and say, hey, momentum is slowing. I'm losing that advantage of momentum. And then eventually both triggers work inside, and you have a weakening or a slowing of the trend. And you have to say to yourself, this is no longer a market which is likely to continue in the direction of the trend. At this point, anything can happen. And you're going to hear that in class. Anything can happen, triggers. And short trades will be taken by you later in life, but they must be managed well. And the only way that you can really manage a trade, guys, is to be a chart reader. And the easiest way to become a chart reader is to insist on momentum in the beginning, to focus on advantages. Weak triggers also at these key areas, guys, these can stop a market in their tracks. They can make it bounce. They can make it reverse. So we're going to use that trigger strength first to establish momentum through rule number 1, and then we're going to use it to understand when we've reached an area where the market is likely to stop. And this is rule number 2. It says no termination conditions, no likely to stop areas. And when rule number 2 is true, not only do I have room to my profit targets, but I also have a clear path. And again, large chart, guys. Large chart leads the way. You can see right now, and guys, please give me a Y in the room if you're with me on this. The large chart has established direction through the green background. The market is going up. The large chart has provided me the best look of momentum because my scissors are open. My small triggers are green. My large triggers are green. They're both wide and angled in the direction of the trend. And guys, look at that space between the two. This is a market that's likely to continue in the direction of the trend. And let's go back before we go to rule number 2. Let me open up my large chart. Look at those strong triggers. There's a pullback. There's a pullback. And it continues all the way to Fibonacci support. There's those strong triggers. There's a pullback. There's a pullback. And notice that it's the weakness that precedes the reversal. Strength, the market pushes up. Weakness, there's your bounce. Guys, this is a great drill for you as a brand new user. You have 10 days of data on your chart. where you can go back and circle these tails when they're strong trigger lines, and eventually you'll be able to put it together to determine whether or not you have a market that's likely to continue in the direction of the trend. So large chart says giddy up. Large chart says we're going up. And now we have to define the areas. Rule number 2. And guys, the areas on a chart that can stop the market, we call them termination conditions. And a termination condition is a Fibonacci-based indicator that may reverse the market. But it's based on a comparison between the trigger lines and the area. So we're looking for blue Fibonacci support on the large chart, red Fibonacci resistance, yellow 1-to-1s, a cyan divergence low line. And guys, what a divergence line is, it's a visual loss of momentum. If the market goes down and then up and momentum doesn't follow, on the third bar up, you're going to see the cyan line print, this negative number. All it does is it tells you we're losing momentum. If the market goes up and then down, as that third bar comes together, if momentum is lost, a negative number will print and the magenta line will print from the top of the pivot. The negative number means nothing. 24% is not better than 4%. It's not worse than 83%. It's just a byproduct of the calculation. But we're going to use these lines because they can cause a bounce. And we're going to use the trigger lines, and that's going to let us know, hey, Ace, good to see you, man. That's going to let us know if the market is likely to stop, if it has the potential to break, or if it's broken. This is going to let you know whether you need to sit on your hands or whether you are clear to follow your rules to take the trade. And guys, these areas on a chart, let me give you guys the map that are brand new. These are where decisions are made. This is where the large crowd is going to react, where buyers will buy, where sellers will sell, where profits are taken, where trades are entered. And guys, you never have to be caught up in their fight because it's a simple recipe to understand whether or not they're likely to hold or break. And I'm going to take a lot of pictures, guys. Every time I vandalize a picture, I'm going to drop it in the room for you. Save it in your spreadsheet. The rules for termination conditions, identifying an area that's likely to stop the market. The first thing that has to happen is price reaches an area. And this is such an important thing because these areas are where decisions are made. These areas are where these guys are either going to buy or sell or take profits or add contracts. And we know about them long in advance, guys. And it's price reaching the area that sets off the decision-making process. So when your dynamic Renko bars reach an area of support, just check your trigger lines. And if they're not below, don't take any more trend trades short on the small charts. This is a giant red flag waving for you, and it says, hey, Jas, hey, David H, JW, Kenny, Scott, GWC, sit on your hands for a second. Because this is an area that may stop the market. This is an area that may create an untradeable bounce. This is an area that may reverse the market completely. And the reality is, and I want you guys to embrace this, you don't know. You never know what's going to happen in the market. You don't know who's got money waiting in the wings, but you do know where the most likely spot for that person to be sitting is. And if the triggers don't break, no trades are taken, keeps you safe, keeps you out of a lot of trouble. Well, Mark, if I can't trade into an area, when can I trade? Well, you can trade when both the small triggers and the large triggers get to the other side of an area. Notice that up here at support, both the small and the large break through. Support begins to behave as resistance. You do have odds favorable momentum, and I'll be darned, there's one of those tails. There's one of those entries that you're going to be able to pinpoint on a smaller, faster chart to get you into this trade. And notice at the bottom of the bar, the one bar in the large chart has not reached Fibonacci support. Guys, this is your best of the best look. This is the broken area. This is the clear path. This is the one that makes life easy for you. Is everybody good with that? It's really pretty simple in the beginning. You're either going to have a clear path or you're not. You're either going to have the best of the best or you're not. And I want you to see how effective this can be. Price goes directly into Fibonacci support. You guys say no more short trades, and you're not separated from your money. And it bounces right back up into resistance, and none of the triggers break. And once again, You're seeing the beginning of a consolidation and you're not getting caught up in it. And then to support, to resistance, to support, to a divergence high, to a divergence low in 1-to-ones, back to resistance, back to the 1-to-ones. Holy crap, guys, there's nothing to do. For 4 hours, this market is caught in a range, and not one of my Nexgen traders got beat up and lost money in it because they couldn't get their rules met. Eventually, it breaks out of the range. Eventually, we can say, hey, look, both small and large are above resistance. It's gotten out of that range that's been holding it. My path is clear, and I have momentum. Perhaps it's time to look for an entry on a smaller, faster chart. Guys, it's the 90% of the day. It's what you don't do when there's nothing to do that's going to allow you to get the most out of the market when the market is giving you these advantages. And that crude oil just put on a complete show for us. So it's either broken or it's not. It's either a clear path or it isn't. And that's the new user run. I'm going to give you one more, and I'm going to draw an arrow to these small triggers. Let's get everything off of the chart. Sometimes your small triggers are going to absolutely smash through the area, 2 to 3 points beyond. But your large triggers, man, they're slow. They're still cranking in the back. They're down, they're wide, but they haven't cleared. This is what we call a 50-50 look, guys. This is going to be your first medium probability trade. A 50-50 trade means that with odds favorable momentum, and it's the only way that we expect areas to break, with odds favorable momentum, this area has the potential to break. Here's the thing that you have to understand. It's not broken. It's not a clear path. Rule 2 not met. And guys, this is such a big part. You have to be able to read your indicators to understand whether or not it's a high probability trend trade or this 50-50 look, which will be your first medium probability trade. But because rule number 2 isn't met, I don't have a clear path. You guys are going to use your chart reading to make sure that momentum is the absolute best and that your entry area is the tightest with the least amount of risk. This is going to be your first medium probability trade. And once again, I'm going to give you a solid plan to take this trade. This is the most lost trade out of all the trades that Nexgen teaches because it's the one where you guys put the most hope into a trade. So this next slide is that little 90% of your day, guys. 90% of your day is reading indicators. Somebody just sent me a message on Discord. Please don't get upset with me if I don't reply. When I'm teaching class, I don't check messages. I might check it at the break. So just, I'm not sure who it was. Don't get mad at me. I'm not looking at it. You guys get my undivided here. But I heard the little thing in my ear. Guys, price is coming up, and it reaches Fibonacci resistance, and the triggers remain below, and every one of you brilliant people in this class says to yourself, you know what? I'm not going to go long into that area. I'm not going to hope that the area breaks because the triggers are below. I'm not going to wish that it goes beyond it. I'm simply going to sit on my hands and see what the reaction is. And guys, the reaction is that the triggers are below and there's a giant push. Right about the third bar, we also notice that there's a loss of momentum. It doesn't happen till down here. So the divergence is not a termination condition. Price reaching resistance, triggers below, that's a termination condition. And it pushes all the way down to support. And when it does, none of my triggers are below support. In fact, my large triggers didn't even join the party. And guys, when price accelerates away from those large triggers, remember they're a moving average, a slow moving average. When it bounces into Fibonacci support, and this is also when a midband behaves as a termination condition, this is what we call the gap theory. If there's room for an entire bar to get back to those large triggers, it's likely to close the gap. It's likely to come back and snap back to those trigger lines. It behaves like a vacuum. And if you try to pull one off and take a short trade, more often than not, you are absolutely run over. From support, can't go short, the market goes back up to resistance. And when it gets there, all the triggers are below and they are noticeably weaker. Notice that the trigger lines don't match the background yet. And then it reaches that divergence high line. And this is what's creating what we call a pivot stop out. A pivot stop out requires first a pivot with a loss of momentum, and second that price reach, exceed, and trades back below. So here's your pivot, and the market comes back, and everybody that tried to go short gets stopped out. And then when it trades back below, that's a pretty good indication that the buyers are coming to play. So pivot stop outs, when price trades above a divergence line, then back below, don't take any long trades. And if it lines up with resistance that is a true termination condition, it adds power to the top. And when a termination reverses the market, excuse me while I brain fart, when a termination condition reverses the market, when a no triggers through, termination condition reverses the market, large triggers roll, small triggers get below, we call this a strong top. Guys, a strong top is the precursor to the absolutely positively highest trend trade that you can take. And that's what we're looking for our first 30 days, just really giving ourselves the best of the best. And you'll notice that off this strong top, we get odds favorable momentum. The bar hasn't reached Fibonacci support, and there's one of those tails, guys. There's your entry for the highest probability trend trade that you can take. So it's what you don't do here that allows you to capitalize in that highest probability trade. And you see it again on this one. Strong triggers, absolutely screaming. Notice that there's no tails. It never gives you a shot at a pullback. Smashes through support, never gives you a shot at a pullback. And then when it reaches one-to-ones, the scissors are beginning to close. And none of the triggers break through the one-to-ones. And you guys are just saying to yourselves, dag nabbit, I didn't get paid on that whole move. How am I ever going to make money with Nexgen if they don't give me an entry? And this is where you have two choices, guys. You can either go ahead and make up some rules and break your rules and try to trade into it and get your butt kicked and get angry and dejected. Or you can just say, man, the market fluctuates. It goes up, it goes down, and I don't always have a statistical advantage, and my money is worth not taking that short. And off the bounce that would have taken you out of your short, it goes directly into resistance with all the triggers below, so you can't go long. And the triggers don't agree. There's not even momentum, and I can't go short, and I'm still below areas, and I can't go long. And then I have one of those 50-50s, but look at that. The large triggers are a full bar away. I still can't go long. And I'm not going short because all my triggers are up, but eventually everything gets above resistance, and I get momentum, and my path is clear. And there's that tail, ladies and gentlemen. There's that highest probability trend trade that happens after a termination condition. And what I see so often is people take the short and they give up $200 and they hope on the long and they give up $250. And they take the short again and there's another $300 because they added on contracts because they're feeling bad. And then they go long because now it's got to break. And they go short one more time because if it didn't break, then man, it couldn't possibly be a long trade. And I have watched people give up $1,000 in this range and have to call it a day. But the reality is if they just waited for this one, all that momentum carries it straight to Fibonacci resistance. And on a 2-lot, that's about $700 worth of profit, which means that if you didn't sit on your hands, even after that beautiful trade, you're still down $300. So what I'm trying to remind you guys here is that it's okay to do nothing. You're not going to be in every move. Each move doesn't provide a statistical advantage. Sometimes these huge moves never give us an opportunity, and I want you to just get comfortable with the idea that it's not your money. That's somebody else's money. And if you walk into a bank and you say, give me all the money, well, you're a bank robber, and you're probably going to get tased and hogtied and sent off to prison. But if you walk into the bank and you say, you know what, give me my money, please. Well, now you're a customer, guys, and now you're going to walk out of there with what's yours. So understand that it's not all yours. Is everybody cool with termination conditions? Feeling pretty good about it? We've got 50 of them right here, it feels like. Price reaches, the triggers don't break. Don't go short. Don't go long, don't go short, don't go long, don't go short. And this happens, guys, from 3:30 in the morning until 9:23, 9:30, when we finally get a break, when we finally have direction, when we finally have momentum. And this is where you guys are going to wait for your opportunities. Sometimes the market turns from nowhere with a clear path. Notice that the triggers are weak, though. Sometimes, even with odds favorable momentum, that thing drops like a Led Zeppelin. You older people get that reference. There's one termination condition that we can find on a small chart that you're going to see on a smaller, faster chart, that refinement chart, that'll help you identify change that's happening on a large chart. Your small chart is an entry chart. I can't stress that enough. Your large chart uses areas to define where the market is likely to stop. To define problems. But your small chart uses lines to define entries. So the only termination condition that I give any credit at all on a small chart is 3 divergences in the same price range. 3 losses of momentum. 3 times where the buyers stole momentum from the sellers, 3 times where the sellers stole momentum from the buyers. And guys, 3 divergences in the same price range on that smaller, faster chart, it may terminate the trend. It may create an untradeable bounce. It may reverse the market completely. But what it really does is it says to you, no more short trades. Guys, this is the only look on a small chart where I will say to myself, hey, rule number 2 isn't met. It's a termination condition. I can't go short because 3 divergences may reverse the market. The same way price reaching a fib and the triggers remaining above may reverse the market. This becomes more powerful. Post a picture for me, please, Andy. This becomes more powerful when your small triggers work their way inside of the large triggers. When you get that weakening, that anything can happen trigger. Because now you have 3 losses of momentum and you also have weak triggers. And guys, momentum on the small chart is the same look as momentum on the large chart. It's a separation between the small and the large. So when you see the small return, you know that you're losing momentum. It becomes more powerful still when that third divergence is higher than the previous from a low, or that third divergence is lower than a previous from a high. This creates a head and shoulders pattern, and some of you old pattern traders may recognize that. But 3 divergences may stop the market, may reverse the market, may create a bounce, and it's going to help you identify on a large chart when things may be changing. So these 3 divergences happen all the time. There's 3 divergences and weak triggers on the large chart, or on the small chart. Even though the large chart says up, even though the large chart says momentum, these 3 divergences get me on edge. These 3 divergences with weak triggers tell me it's even more likely to pull back a little bit. And then when we talk about rules, you're going to realize that the rule number 3 won't be met either. Thank you for the picture, Andy. Because we're going to the small chart for the entry. The large chart, and I'm going to show you the picture here, the large chart has defined direction. The background is green. The large chart has given me the best momentum that I could ever hope for. Small's above the large are wide, they're angled in the direction of the trend. Whoops, sorry. So the large chart has given me rule number 1, the advantage of momentum. The large chart has defined the areas. It's told me that I haven't reached resistance and that I've cleared the previous and my path is clear. So my smaller, faster chart is where I'm going to take this 1 bar and I'm going to dissect it. I'm going to get literally like an X-ray of it. And I'm going to refine that broad stroke of a brush. I'm going to pinpoint where the market is most likely to continue. And rule number 3, the advantage of the entry spot, the likely to continue point, you're going to use a limit order at an area inside of favorable large triggers. And I'm going to break this down for you guys. You're going to use a limit order. You're going to wait for the market to come to you. And what's pretty outstanding is that when everything says up and there's strength and a clear path, you're going to wait for the market to come down. You're going to buy low at Fibonacci support. And when everything says down and the path is clear, you're going to sell high. at Fibonacci resistance. And rule number 3 says that you're going to be so stinking good at pinpointing where that's most likely to happen that you're going to use a limit order. You're going to wait for the market to come to you. And you're going to wait at an area. And an area on the small chart for entry is defined as Fibonacci support or resistance, yellow 1-to-1s, or the mid-band. And you're going to wait for that market to come back to you to those areas inside of what we call favorable large triggers. If this H and S, what is H and S? In red area, it will be a good long. Tell me what H and S is. Guys, I have to get to know you. No, Jess. If the rules are met. So here's one of the cool things, and welcome to the room, by the way. Great question. We don't trade head and shoulders patterns. We don't trade, what are the other ones? Flags and S's and flying V's and angry squirrels and all these patterns that people look for. Because the reality is that we have a methodology that's been proven over decades. And it doesn't require the patterns. It requires 3 advantages. The advantage of momentum, dictated by the large chart momentum, the advantage of a clear path through rule number 2, and then defining our entry point. That pullback, that's what the small crowd does for us, directly to an area inside of what we call favorable large triggers. And favorable large triggers means on your small chart that the large triggers, the same ones that establish momentum, and your synthetic triggers, which are nothing more than the large triggers from the large chart, should be one on top of the other. They should be trending on top of each other because this provides you with what we call the smallest window of opportunity. And your window of opportunity where you're going to wait with a limit order is going to be at areas inside of those triggers because they're moving averages. And moving averages provide a correction point for the market. But we do one better, Jess, is we don't just wait for it to correct to the triggers. We give it something to bounce off of. And the tighter that those large and synthetic triggers are on top of each other, the more likely the market is to ricochet, to go with the momentum, to head in the direction of the trend that the large chart's established. And I think that, if I'm not mistaken, let me minimize this real quick if I can. I want you to see this. Odds favorable momentum, right? The path is clear. It hasn't reached Fibonacci resistance, but 3 divergences with weak triggers said, hey, rule number 2 isn't met. And then, Andy, did you catch this? That your only line wasn't inside of trigger lines. And rule number 3 states very clearly that in order to have the highest probability trend trade, that my areas must be inside of triggers. And my area was on the wrong side of the triggers. It was beyond that correction point. So not only if you refuse to believe rule number 2, rule number 3 kept you out of this loser as well. And this is what we do, guys. Every day is you're not looking for trades, you're looking for rules to be met because your rules provide a statistical advantage. And the more you get focused on this in the beginning, the more you get focused on the idea that the only way you're going to take a trade is if your rules are met, then the quicker you're going to get to where you want to be. The less opinion that's going to go into your trading, and typically that's going to eliminate a lot of unnecessary losers. So when everything says down, when the market is strong, when the path is clear, remember the large chart is one bar. The large chart is that most current bar. That's it. So we have to take an x-ray of the bar. We have to break it down into 15 to 30 bars. So the bottom of the most current bar, and guys, this is where it's going to be when the market is live, should be the beginning of your pullback to the areas. That'll be the low on the small chart. The tail, the top of that bar, should be an area of resistance inside of favorable large triggers. So all of this from the bottom to the top and back to the bottom happens inside of just one bar. So your large chart will always say down. Your large chart will always say momentum. Your large chart will always say clear path. But your small chart in the dissection process may show you smalls turning against it. It might have a divergence. But the large chart leads the way. And you know what? Less opinion, Bob, is one of the greatest things that you can ever do for yourself. Because I don't know about you guys, but my opinions are wrong a lot. My opinions are worth exactly what you guys pay for them, which is nothing. But what I do know, because I've studied it, because I've taken 10,000 pictures of it, because I've put the time in to simulate it, because I've presented it to my mentor and said, hey, am I doing this correctly? And the feedback was, well, at first, no, you're screwing it all up. Let me teach you how to fix it. But eventually it got pretty solid, is that I let the large chart lead the way. And the large chart has to have strong triggers. And the large chart has to have a clear path, new users. This is the easiest way to get to where you want to be. And when the large chart has the advantages in place, momentum and a clear path, I wait for a reversal bar to signal the start of the pullback. This reversal bar is not my entry. This is the beginning of the pullback. This reversal bar hitting the triggers is not my entry. This is the beginning of the pullback to one of the correction spots. So I'm going to identify the triggers. I'm going to identify the top of the line to the bottom of the line. I'm going to identify my correction spot. And then once I identify where the market's likely to correct to, I need to give it something to bounce off of. So I'm going to do that by identifying the lowest point of resistance, which happens to be Fibonacci resistance, to the highest point of resistance, which is this magenta midband. I don't worry about this resistance up here, and I'm not concerned with these yellow 1-to-1s because they're outside of the triggers. My areas need to be inside of triggers. From the lowest point of resistance to the highest point of resistance, guys, this is your window of opportunity. This is where the market is most likely to continue. This is where you're pinpointing. This is what you're looking for your first 20 days. And once you identify that window of opportunity, you're going to activate a limit order about 2 ticks below the lowest point of resistance in that window. And then you're going to pray, or you're going to wish, or you're going to do whatever you can do. And the wish, the dance you should do is that the small crowd has enough behind them to get you to that area inside of favorable large triggers. But the cool thing is if they do, well, you're going to find yourself in a short trade with odds favorable momentum. And you're going to find yourself in a trade with no termination conditions. And you're going to find yourself in a trade having entered where the market is most likely to continue. And guys, this is your highest probability trend trade ever. So to the long side, everything is dependent on momentum and a clear path. If it doesn't happen, guys, it's okay to say it's not my trade. But once it does, you're going to wait for the reversal bar. And when that reversal bar prints, you're not entering the market. The first thing you do is you look for trigger lines. You look for your large triggers, your synthetic triggers, and draw a box from the top of them to the bottom of them. This is not where the market is likely to continue. This is where I'm going to look for areas. So the next step is to draw a box from the highest point of support to the lowest point of support inside of favorable large triggers. This is where the market's most likely to continue. And guys, both this short and long scenario is on the spreadsheet that I gave you. And once I define the window of opportunity, the woo for you Ric Flair fans, the only thing left for me to do is right click on my chart and activate a limit order. Guys, the market is way up here. And I already know exactly where I want to enter. I've pinpointed my entry where the market is most likely to continue. So Jas, you ask, is this a good entry on the S&P? The challenge is I don't see an entry, my friend. Are you asking for a long trade or for a short trade? And I'm going to show you one of the things. So for a long trade. And Jas, this is why we talk about rules. So this is your large chart, right? The background is red. So the market's going down. Over here it was up. But as long as the most current bar is showing me a red background, as a brand new user, my best option is to only look for trades to the short side. My small triggers are below my large triggers. My large triggers and smalls are separated, they're wide, they're down. So even though we've reached an area, I actually have the best momentum look down, which for me says that it's too soon for a long trade. Price did reach support and the triggers didn't break. So Jas, what we have here is in the moment when price reaches it, this tells me no shorts, but it's too soon for the long because I don't have momentum or a clear path. That was kind of stacked there. Let me fix that up. So all we're doing is chart reading. The trend is down, the momentum is down, but it did hit a termination condition. You did get those 3 divergences, right? So what this says is, hey, this may be a bottom, but it might not. We're not sure yet. But with all this momentum in the direction down, I'm not doing anything yet. I'm not going to go short into the area, but I'm not going long against that momentum because even though it's a termination condition, that much momentum is hard to stop. And you'll see a retest quite a bit, which is why if you went short here, it retested. And if you did it again, it retested. And we're at that next retest point. We just don't know whether it's going to go up or down. So Jas, what we're going to do in this situation as a brand new user, and again, I don't give trading advice. I don't tell you when to go long or when to go short, but I can tell you in this particular trade, rules are not met for a long or a short for a high probability trend trader. And then when you start learning to read the charts a little better, you may say, with 3 divergences at a termination condition, I may begin to recognize when it's okay to look for my first long. And we call that an HVA trade, and it's in the manual. And I don't teach it very much in the classroom. But my next, and I love that you posted this picture and asked if it was a trade. But my next long has to have momentum. I'll just put momentum and a clear path. And my next short, the small triggers must break the area. So what you come into is this idea that the large chart tells you it's just too soon for longs. And the small chart is showing change, but it hasn't changed enough yet. So we find ourselves in that holding pattern right now. And then if you go back to the rules, and I don't know that I have the S&P up. Let me pull the S&P up because I want to see what happened after that. I'm going to pull up the S&P on my charts because I do want to see what happened after that. So while those are loading, let's go through the entry again. So Jas, there's going to be, is it Jazz or Jas with an S? I had a friend growing up that was Jazz, and that's what I keep seeing. Well, that's the same thing as it says, silly. With an S. Got it, S sound. And Jas, you'll find that we're pretty laid back in here sometimes. Reversal bar prints. Identify the triggers. Once you identify the triggers, look for the areas within, and that creates your window. Your limit order goes right at the top. And guys, this is just showing you where to pinpoint the entry. Reversal bar. Find the triggers, the area within, limit order just below. That's your short entry. When you put the 2 charts together, mine are loading right now, Ron, but if you need to squish a chart, there's a whole section for that, and I have a feeling that you're asking for someone else, but if you need to squish a chart, you can grab hold of the vertical over here and just click it and drag down or up. Down will squeeze it, up will make it wider, and the same thing here. If you click on the timestamps, if you go left and right, you'll see it going back and forth. And then here's a great video straight from YouTube on it as well. And then once my ES comes into play, I'll go through and do it. But what this is doing is this is kind of showing the process, guys. Odds favorable, clear path, and we're not circling the tails, guys. What we're doing is we're waiting for the pullback to support inside a favorable large trigger. So this is going to be your study tool. So for you newer folks, Zorro, David Age, Jas, you guys that are really focused on that high probability trend trade, Rob, when the rules are met, whoops, sorry, I'm going the wrong way. When the rules are met on the large chart, and this is historical, go back and circle it. Circle a tail. And if that tail lines up with support inside of favorable large triggers, well, you know that you have a trade. You know that you have the highest probability trend trade. You know that this is the best of the best. Guys, this is the one that I want you, when you take the picture, I want you to go from the top left to the bottom right and get both charts. And I want you to annotate strong triggers, no terminations, area inside of favorable large triggers, and upload it to Screencast, right? And then once you do it, drop it in the room and get verification that it is in fact the best of the best. And then once you have verification, I want you to go to your favorite looks. And guys, you didn't even take a trade. All you did is go back historically and find the look. And I want you to paste it into your spreadsheet. This is my best look. But notice that it's appscreencast.com. Guys, we can turn this into a hyperlink by going to the Insert tab, and all this is in the study user guide. I'll give you the link to it. Click on the link button, paste the address in the address like you're going to Google or eBay, and call this perfect long. This long is so stinking beautiful that I never want to miss it. This long is what I'm looking for when the market is live, but I can recognize it when the market is not live. So utilize those pictures and utilize that spreadsheet. And then guys, when you know where the market is most likely to continue, and this is why we talk about trade entry precision for the first hour, you get this understanding where the market should not go. The market should not go beyond that window of opportunity. This is where your initial stop gets placed. This is where your protective stop gets placed. This is where you say, if that small crowd can push beyond the window of opportunity, 4 or 5 ticks beyond it, I no longer want to be in this trade. We'll go through one together, Kenny. Let me talk about stops real quick, and then we'll go find a market example, and we'll do it bar by bar. I can't talk, but we will do it. Window of opportunity, initial stop goes 4 to 5 ticks. For everybody, and this is important to me that you guys understand this, and maybe write it on a big piece of paper with your brightest crayon. You will take losers. You will lose trades. Anything that wins 70 to 80% of the time, it's obligated to lose 20 to 30% of the time. Small losses are a normal part of a positive equity curve. Small losses aren't something to be fretful about. They're not something to get angry about. They're not something to be, oh my gosh, I suck, this doesn't work. Guys, losses are just it's a cost of doing business. My goal for the new user is that you take the correct losses, right? If you're going to get your butt kicked, get it kicked with momentum, a clear path, and an entry area. Always have a statistical advantage. And that's one of the best things you can do for yourself is make sure that if you're going to take a loss, first, let it be a small loss. Put your stops in the right spot. And second, make sure that you had every advantage, got in at the right place, took everything there. And Ron's right. Everybody takes losers. Cost of doing business. And the cool thing is if the market gives you a reversal bar down or a reversal bar up, you can reduce risk even further, guys. And this is really one of the magical things about Nexgen and this methodology is that if you embrace the idea that you can go a tick or two above that reversal bar, You'll have trades that don't work out, but because of your precision entry, because of your adherence to rules on stop placement, you're going to have trades where you lose 2 or 3 ticks. And 2 or 3 ticks is not, man, it's not bad, especially if you're waiting for the best of the best and you're able to hold to those next areas. So I want you guys focused on entries first. I want you guys focused on the best of the best. And then Jess, I want to see where your market bounced. And I want to make sure you're on the right market as well. So Jess, your picture, was it 51.96? You are trading the correct 51.96. All right, so Jess, you and I are a little bit off. And I want to see what your timestamp says. Are you hanging out in California, Jess? Because your chart's even better than mine on this one. Okay. So one of the things that we talked about this in the room, oh man, Kenny, do you have like 3 or 4 minutes? Cool. Okay. I'm going to come back to yours in just a second, Jess. Kenny, let's do this real quick. I circled the tail, and here's my pullback. So I want you to see the whole process of finding that long trade. And this one didn't really come up sweet for us, but the basic idea is when everything says up and the path is where we want it to be, you're going to wait for the reversal bar. And when you wait for the reversal bar, it's going to print, and then you create your window of opportunity. The first thing is from the top line of the triggers all the way to the bottom line of the triggers. And this is where you're looking for areas. So you can refine that process, Kenny, to the highest point of support, to the lowest point of support inside of those triggers, and this becomes the point where the market is most likely to continue. Whoops. And 1 or 2 things are going to happen. Man, I keep hitting the wrong button. I apologize. The market is going to come down, and it's going to hit your area, or it's going to miss you, in which case it simply wasn't your money. But that's how you're going to define where the market is most likely to continue. So first you draw a box on the triggers, and then you make it even smaller by identifying the areas within. And sometimes it's going to work like a champ, and sometimes it's going to miss you. But what you'll find is more often than not, the highest probability, easiest winners pull back to areas inside of those triggers, right back to that area inside of the triggers. Does that help a little bit? So if you don't see synthetics on your 5-1, right click and go to templates and go to load and go to the 5-1 Renko bar chart. And what that'll do is it'll just reload the template for you, and that should get the synthetics on for you. And that'll definitely make pinpointing entries a lot easier. And I know you got a bolt. If you find yourself with a question later, you can always DM me. Guys, I try to respond to them. All right, so Jas, let's look at what happened after, and you had a fib here. So Jas, the one thing is you're on Pacific time. I'm on Eastern time. So you and I have a different midnight, which means that we will have different fibs. And guys, this is part of it. Grant asked earlier. He's in Louisiana. He's my next door neighbor. But check it out. So when you presented in the room, Jas, we had gotten to this point right here. And we still had momentum down. And you were bouncing off of a fib. And it had pushed all the way up to resistance. And everything was angled down. So we weren't looking for a long yet. And it did go up a little bit. 3 divergences off of a fib pushed the market up. And now I've got 3 divergences. And it appears to be pushing the market down. And Jas, this is cool where you wait for the rules to be met because all of my triggers are below resistance, but my small triggers are up. So what I really need to do is I need to wait for these to agree a little bit. I need to wait for my clear path. I need to wait for that momentum. So there's two options. We said either this area needed a break, and it never did, or to take long trades conservatively, we need the roll here. We need to see everything going up. And rule number 2 right now, Jess, is keeping you from forming opinions. It's keeping you from hoping and wishing and wanting, and we're just in a holding pattern. But I can tell you from experience that since this pivot didn't come from an area, and because it made it all the way to Fibonacci support and this area never even broke, one of the patterns that you'll begin to recognize with a little time is it's probably more likely to go up to 52.08 than it is to go down to 51.92. Because now we're coming off that termination condition. Now my small triggers are going up. This area never broke. And then because these areas are where the people in charge love to take profits, they love to get to, very often when you see a bad top, when it doesn't really clear, a lot of times they're looking for that next fib. It's never guaranteed. I don't have momentum. I've got flat triggers and everything is below. They're not above. I don't have any rules, Matt, but we'll see what happens. Another lower divergence here, and I'm totally wrong. That's why I don't take a trade based on opinion. I simply wait for my rules to be met. And guys, that's a pretty good lesson for you. Just waiting for the rules to be met. So here comes the second half of what we're doing. If you don't have a written plan, you don't have a plan. If you don't know exactly what it takes to get you into the market, you're welcome. And Jas, we do this every day. Every day. So the repetition really gets you to where you want to be. Day one, it's like drinking from a fire hose. It's a lot to take in on day one. But if you keep it simple and you focus on entries first, then you're in a much better position. All right, we did this yesterday, and Jen, I think you told me to save it. Thank you for that. There's things that you need to know before you ever sit down, guys. You first need to know what your rules are for entry. You need to know what it's going to take to get you into the market, because if you're not sure, what you're going to find is you're going to trade your opinion. And guys, our opinions are very much, well, you know what opinions are like. And then once you know how to get into the market, you have to know how to manage it. So you have to have clearly defined management rules after you enter. And this depends on what type of trade. And what type of trade it is creates a variable. If it's the highest probability trade, you're going to manage it one way. If it's a medium probability trade, you're going to manage it more assertively. If it's a momentum style trade, you're going to have to make sure that you understand when momentum is gone. And guys, these are the two most important things before you enter the market. And none of you have the skill set yet if you're brand new, not using the software. Thank you for catching that, Jen. So what we do is we keep it very simple and focused in the beginning. And guys, this plan that I'm giving you right now, I've been giving it out for well over a year. And this plan is designed to optimize your chances of success with a high probability trend trade and that medium probability 50-50 that I showed you. And it's just a stepping stone, guys. This is the beginning. This is turning you into a chart reader. Very few people stick to this plan exclusively. The ones that do, it's weird, they go off to become professional day traders because they have patience. But through simulation and study and class feedback and continuous practice, guys, you're going to create your own plan. You're going to take those pictures of the best look, and that's going to enter your plan. And it's all going to be based on your ability to read the indicators. So your simple plan for consistency, don't fight the large chart. Guys, let the large chart lead the way. Don't be a hero. Don't say, well, I know everything says down, but I really want to go up, right? Or the momentum is strong, but I think I can beat it. Guys, salmon die when they swim upstream. So the easiest way to commit financial suicide, in one easy step, is trading against strong triggers. Trading in determination conditions. These are the two most common mistakes that new users make. This KISS plan is designed to keep you out of that through the high probability trend trade. So you're going to define your entry. And as this is a solo sport, there is no we in trading. My brother and I talk all morning, but there is no we. It's a me and it's a him. Or salmon get clubbed or eaten by bears or whatever. It's a horrible life to be a salmon. Define your entry. Get in at the right spot. Can you get this? The KISS plan? Ah, Jess. See, you just met me. You don't know this. But I absolutely love you guys. I give you everything you need to be successful. There you go. I just dropped it in the room. Not only will I give it to you, I'll teach you how to execute it. But it all begins on entries. And I've never had anybody trade the high probability trend trade exclusively to be able to mark yes for each and every one of these conditions and do worse than 70% ever in the history of the plan, guys. So I'm also going to give you this checklist. I want you to print it out. I want you to put it on your desktop, and I want you to begin to police yourself. And my goal is that you never say, hey, Mark, is this a long? You can say, hey, Mark, check it out. The rules were met. This is a long. Hey, Mark, the rules were met. This is a short. Win, lose, or draw, this look gives me a statistical advantage. And then for you guys that are working and getting there, here's the exact same checklist with that good top or bottom, that strong top or bottom. There's your momentum. There's your three options on termination conditions. The only one that's high probability is the clear path. There's your termination, and there's that potential to break. And this teaches you the window of opportunity, where to get in, exactly, where not to worry about, what sets it off, what to look for. So guys, I'm giving you this one as well. So not only are you getting the KISS plan, you're getting the visual of what each rule looks like. You're getting something to print out to put onto your desktop. I can't stress enough. Adherence to the rules is your path. Taking pictures of everything you see dropping in the room, this is your path. And once you learn to get in at the right spot, guys, great entries create manageable trades. Great entries reduce risk. They maximize profit potential. So you're going to have to manage the trade. And then there's that clever phrase again. You will craft a plan tailored to your personal goals based on your experience reading the indicators. This is a big part of where the spreadsheet comes in, because for the brand new user, management should be just as mechanical as the entry. Management should be just as opinionless as the entry. And it shouldn't rely so much on your chart reading, but rather if-then scenarios. If the large chart says go, then I enter at the lowest point of resistance inside of favorable large triggers. My initial stop is where the market shouldn't go. The one where you build your own plan, Ace? Fill in the blanks. Cool. So that's the one. And the one that Ace just said, Ace said, hey, I'm working on my own plan right now, Mark. I'm working on putting things together that fit my needs and my chart reading. So I created a template where he can go through and begin building it. And then Ace, I have to say this, you're cordially invited to share your plan with me. You are cordially invited to share your pictures and work through it. Work through any issues that may be with the plan. Work on recognition. Take advantage of this class. This class isn't just for brand new users. This is for each and every one of you, whether you're on day 1 or day 100. So don't ever feel like you have to do it alone. Cool. So your entry is based on the high probability in at the best spot. Your stop goes where the market shouldn't. And at this point, there's nothing for you guys to do. You're either going to take a loser, and I want you to be cool with it. Your limit order is used to initiate the trade, Rob. So your limit order at the area, if price reaches it, this is what gets you into the trade. That's a great question. Your ATM strategy is over here on your chart trader, and your ATM strategy is going to tell you where your stops go and what your targets are. So, for example, if I'm trading the ES, I'm going to use a 2 lot, a 12 stop, and like a 10 and 20 target. So I'm going to put a limit order just below the area of resistance inside of favorable large triggers. And then if it enters the trade, my stop is at 12 ticks initially, but I'm going to put it where the market shouldn't go. And then my targets are off in the distance. If maybe I put it at support, maybe I put the second one at the second level of support. And guys, I'm not saying that this is a trade because you'll notice that I don't have odds favorable momentum. You'll notice that I didn't wait for the area inside of favorable large triggers. But coming from a termination with everything down, I actually like this trade. Let's see if we can get to 96.25 and let's see if we can get to 94.25. We'll come back and see it. So your ATM strategy allows you to put the stop where the market shouldn't go. And there's nothing to do after this. And if the market gives you a reversal bar in the direction of the trade, well, then you're going to reduce your risk 2 ticks above that reversal bar. And then once again, there's nothing to do. It's either going to stop you out or it's going to hit your first target. And your targets are at 100 and 200. And if it doesn't stop you out and it hits your first target, guys, you're $100 in the bank. You're feeling great. Life is good. Everything's wonderful. You're excited about life because you just got paid, and confidence comes through the memory of success. And you're going to move your stop to break even because break even takes all the fear out of the trade. It's not the smartest stop. You're going to change your stop placement based on your ability to read indicators. But for a brand new user, going break even takes all the fear out. You're already 100 in the bank. You have nothing to lose. So if it hits your second target, you just made $300. If it hits your stop, you only made $100. Guys, $100 a day is $500 a week, is $2,000 a month. That's an extra 24 grand in your bank, right? Do it on a 2 lot and do it 200. And that's an extra 48, right? Do it on a 4 lot and it's 400 and now you're at 96. And what happens is it's all about taking the best trades, making sure that the advantages are there. And let me put you in here, Exhibit A, weak triggers. And we got run over. Weak triggers. Rule number 1 wasn't met. Does everybody see it? Guys, this was simulator. I couldn't care less about taking that loss. I broke the rules. I should take a loss. But what I have to do, and it's nice when the lesson comes into play, and some people are like, oh, Mark just lost a trade. Let's go through and annotate the chart. Whoops. And I want you to see how easy it can be for you as a brand new user. Did I have odds favorable momentum? Did I have strong triggers? Is this a market that was likely to continue in the direction of the trend, guys? On the most current bar, this is what I'm looking at. HJ says no. In fact, they say anything can happen. Guess what, guys? It did. I lost the trade because I broke my rules, because I didn't have the advantage of momentum. This wasn't a market that was likely to continue in the direction of the trend. This was me forming an opinion because everything was red. I gave it away. So I can't expect this trade to win 70 to 80% of the time. I can't expect this to be the best of the best because my rules told me that it wasn't. And guys, this is what I want to get you focused on, is this is designed to optimize your chances of success. You're going to understand. You're going to learn your rules like a scholar. You're going to break them like an artist. But until you know exactly what you're looking for, guys, keep it simple. Keep it focused. Post in the room a lot. Your management is dependent on the trade. When you go to that 50-50 trade, and you guys, does everybody remember what a 50-50 trade means? Is that you don't have a clear path. Whoops. A 50-50 trade means that the area hasn't broken, that only the small triggers have made it, that the large triggers haven't. So what does that mean in the grand scheme of things? It means that I've forfeited rule number 2. It means that I'm hoping that an area breaks. And since I don't have momentum, this is where I make this little slide path. Or since I don't have an entry area, or a clear path, excuse me, I have to insist on momentum. I have to insist on the perfect entry area. So a 50-50 trade tells me, let's zoom it out for us old people, that I don't sacrifice momentum on the large chart, that I don't sacrifice momentum on the small chart. And then it reminds me that divergence is a loss of momentum, so if it's present, I have to mark no and not take the trade. This is the most broken rule on the 50-50. And guys, I also want it to be a termination that reversed the market because decisions were made to move that market the other direction, and then I'll get in at the area. And divergence is so freaking important that it says don't enter with divergence a second time. But because it's medium probability, my management is different. My entry point is the same. My stop behind the reversal bar is the same. And then there is the third reference to getting the hell out of the trade with divergence. But for some reason, nobody believes it. My first target's $100 or the trouble spot. My second one is 200. Guys, this is not a home run. But if you learn to take it, if you learn to recognize it, if you put yourself in a position where you can say anything can happen triggers is likely to push me up higher because there's no momentum behind it, then you avoid the loser. If you say price reaches yellow 1-to-1s and none of the triggers have broken, you're more inclined to not attempt to take a long into an area that may stop the market. And then this is the NASDAQ. If your small triggers are strong against you, you're not taking that trade. And I'm sure some of you have seen that. Guys, this is one of the biggest things on the NASDAQ. And you've got to do it. So there's that 50-50 live. There's your divergence. There's your weekend triggers. Can't wait to see what happens. You guys watch it. Let me know what I miss. I'm going to go stretch my legs because I'm not going to lie to you guys. If you sit and watch the market too long, especially if a trade doesn't come to be, what you're going to find is that you'll start to fabricate. You'll start to create scenarios in your head that maybe don't fit the rules. So I'm going to go stretch my legs. I'm going to walk a lap, pet my dog, smile real big, and then you guys can do the same if you choose to. I'll be back in about 5 minutes. Mic silence for just a minute, guys. All right, it was a quick break, but I'm back. Guys, rules for the win. There's 3 divergences. There's a higher divergence, right? Now the small triggers are against it. The area never broke. How many red flags do you need to not get caught up in trying the short 4 times. This is all we're doing, is we're just talking about rules. We're just talking about advantages. We're giving ourselves a chance to not give it away, right? Guys, I don't mind losers. Losers don't scare me in the least bit. I'll take them. I'll embrace them. I won't fight them. But I want to make sure that I'm taking the right losers. I want to make sure that I'm not breaking rules, that I'm not giving away too many advantages. So the second half of class is looking at what you guys are doing. And then Jen, you did it in the moment. Jen says, no, not weak triggers, Jen. Well, maybe at the time. Smalls are up, larger down. Is that what you're referring to? The colors don't match, right? Remember that lesson from the very beginning, guys? If the colors don't match, you don't have odds favorable momentum. They're not really weak, they just don't agree. I love it. And then you're like, divergence, not broken, sit tight, divergence, 3 divergences, egads and little fishes. Maybe I should be patient. Jen, your money is worth taking the best trades. Nice job. And guys, this is it. Jen, you've been with me, what, 3 weeks now, maybe? And I know that you have 2 weeks. And I know that you have a history in the markets. But doesn't it simplify it when you've got some concrete rules? And I want to hear it from you newer people too. It doesn't have to be difficult. It doesn't have to be this mind-bending, oh my gosh, stressful thing. Just waiting for those advantages. So guys, I'm going to scroll up to the top and I'm going to start clicking on stuff, and we're going to look at your charts. And I'm going to tell you guys right now, and you know what, let me put this disclaimer out there. I haven't done this in a while, but I think that we really should. The key to everything that we do is foundation, guys, to being able to look and recognize. So for you brand new users, I'm going to make it as simple as I possibly can. I'm going to make it to where termination conditions are bad, to where no momentum is bad, to where not getting in at the areas inside of favorable large triggers is bad. And it's going to frustrate you guys because you're going to be like, I never get to take a trade. But what you're doing is you're learning to read your charts. And guys, I promise you, this little safety net that you give yourself in the beginning is going to make it easier for you to be successful here in the near future. This is a marathon, not a sprint. The more time you spend with it, the more you'll see, and it opens door for you. But before I go read people's charts, I hopped in and I got paid. And Roku knows that with this much momentum and a clear path, he can take advantage of it in small chunks. And he does it effortlessly and flawlessly. But it's not a high probability trend trade. He never waits for the pullback to an area inside of favorable large triggers. And then here, he gets in at the fib without the clear path. And it kicks his ass. No offense, Roku. All the momentum in a clear path, it's effortless, and Roku gets paid. Decreasing momentum and not a clear path, and suddenly he's taking losses. Roku, do you see the difference between the two? And I don't tell Roku that it's good or bad. I don't tell Roku that he's right or wrong. I don't tell Roku that anything he has done is outside of what is appropriate because it fits his plan. But I will tell him that with momentum and a clear path, he almost would have had to go short to not get paid on this trade. And then once he gave away his advantages, things got difficult. So it's an awesome lesson. And Roku's going to take both of these pictures and look at them tomorrow, and he goes, you know what? I'm going to keep doing this, and I'm going to stop doing that because really I'm in this to make money. Roku, great trading. You've been so consistent, and it's fun to watch you grow. And there's a lot to learn from them, Rob, and this is why I talk about them in advantages. All right, so Andy, this is one of my favorite things to see on a chart. Anytime you start your sentence with "here I'm guessing," half-truths, right? Here I'm guessing half-truths, because Andy knows that he's going to misapply some lessons the same way I did, the same way all of you will. So let's go through it. You know that the one thing that you didn't talk about, though, or actually the two things you didn't talk about, is, Andy, your chart is void of momentum reference, and it's also void. No, you do have 50-50. So let's talk about it. Rule number one is momentum. And check it out here. You have a mid-band, large triggers a full bar away. That's a good bottom. That's a good bottom. That's a good bottom. There's a lot saying that this market's going up, Andy, without a doubt. You do have odds favorable momentum. All right, new users, help me out. Price reached a divergence high, and absolutely none of the triggers broke through it. Is it a clear path? No. Is it a 50-50 if none of the triggers broke through, Andy? No. It's a great lesson. Man, I had to go through all of this, Andy. I promise. It's not a 50-50 because my small triggers aren't through the divergence high, which means that it may stop the market. And here's another thing that I look at, guys, is I'm trying to break 85, I'm trying to break 92, and I'm trying to break 96, which means that I am trying to break 11 ticks worth of distance. I'm hoping that all of these areas break. It's a lot. And then Andy, you said you made it just past 81.95, and now it's struggling. Severely managed out again. Keep making this kind of 50-50 trade. So now we're recognizing patterns. I think it is, Rob. And I think that when you get to this look, and then here's the flip side of it, Andy. Because I don't want it to be all beating. When those triggers break through a little bit, and then this behaves as a termination, the market's more likely to go up than down. Because of the level of momentum, Andy, it's a good look. Because of your perfect entry, you at least have a fighting chance. You get out at the trouble spot, right? I can't tell. Did you get out both contracts at the trouble spot or just one? And guys, this is where management is the second side of it. So from a good bottom, with all that momentum and a perfect entry, one off at trouble, and go break even and see what happens. And see if momentum wins. You pulled them all together with the looks of failure. This increases the odds. This increases the odds. This decreases the odds. Did you have divergence on the first one, Andy? I can't see it. You hid it from me. Was there a divergence on the first pullback? It doesn't look like it, but I'm not sure. So if there's no divergence here, it's even better, right? Take a shot with all that momentum coming from a good bottom. No worries. Your exit's perfect. Right at trouble. And then once you're break even, if all that momentum from a good bottom breaks it, dude, you're home free. Let it run. Does that make sense? So I'm not knocking the trade. We're identifying the advantages. We're identifying what may have created problems. And then all it's doing, Andy, is it's saying to you, because I'm aware of issues, I'll have to manage more aggressively. It was going so slow you thought the second would fail. You know, people used to say that I was so slow that I would fail. And it didn't work out that way. But yeah, crude oil in the afternoon is like watching paint dry. I hate trading crude oil in the afternoon because the more time you sit thinking about a trade, the more your brain is going to tell you you need to jump ship. And you did, Rob. We just went through repetition with you, and now you're simulating, now you're learning, and you're getting there. Dude, your reads are solid. because you learned how to be a chart reader before you tried to be a trader. Andy, I love the trade, brother, and I love the management, but you're right. When the market's moving slow, it becomes a little problematic. That little devil on your shoulder starts telling you why you're not going to win. All right, and VM Tech posted this one. Whoops. Sorry, let me get the one that's clear. And I love this. And guys, I want to show you one of the advantages of the classroom. And VM, I know that you're not with me, but you will listen to this tonight. So one of the things that we talk about a lot is we talk about having a clear path, and we talk about having momentum. And when you post in the room, one of the cool things is that I'm going to begin to recognize your patterns, whether you're an early entry guy or whether you are trading into a termination conditions person or whether you hold longer than you should. And then once we recognize your thing, we get to have a conversation and we get to work together to fix it. Well, a couple days in a row, VM's thing was trading directly into termination conditions, trading directly in the areas that were likely to stop the market. And it was creating this huge risk, this insane amount of exposure. And then it was one simple conversation. Let's go ahead and make sure that we have a clear path next time. And then suddenly we did get the divergences. The pull-up comes, but everything is down, right? In on the correct side, out at the trouble spot. Let the trouble spot clear. The pullback comes up. Your entry is a little bit, well, you are at resistance inside. Your stop is appropriate. And you take it down to the next slowing down there. And VM, this is outstanding. And congratulations on reaching your target. But guys, one of the easiest ways to get to where you want to be is post in the room and let me see where your chart read needs a little help. And then we'll figure it out together. We'll work on a plan to get you to the other side of that problem. Whether it is saying let's manage it a little more aggressively, or whether we're just saying, hey, we've got to watch out for this or that. You know, weak triggers and two divergences, guys, it's going to push lower more often than it doesn't. And I think we talked about this one early. And then there's my favorite word once again. And new users are going to use this one, and it's going to kill you. But rule number one wasn't met, but if it works anyway, it's 30 ticks. And man, I won't say who it is, but someone used to tell me, if it goes, which is a great way to say, even though my rules aren't met, if for some reason I break my rules and this one wins, I'm going to look like a badass. And kids are going to sing songs about me. And guys, it's a rough plan. It really is. And it's so much easier if you just wait. And this was, who was this? I know, I just saw it and then oh, this is Zorro. So Zorro, I love the way you trade. I'm not going to lie. Overwhelming momentum clears the area, Zorro gets in. Big ugly fib, Zorro gets out. Weak triggers, two divergences, clears the area, Zorro gets in. Zorro gets out. Momentum to the upside, Zorro gets in, Zorro gets out. Really, Zorro, you're 7 days with me. And it's odds favorable momentum for the win over and over. Absolutely stunning chart reading. And magnificent results because of it. Momentum every time, guys. Momentum for the win. Zorro, I have goosebumps. Nice job. All right, Haji, if this is a 50-50 with divergence, I'm booting you from class. Let's see what we have. We have odds favorable, and we have a clear path. I love your long trade. And then you're out at trouble, and then you're out again. Let's get paid. I love it. And then as it pulls back, you still have momentum, and I do like the look, Haji. Yeah, Zorro's totally going to get a robe. And this is where, so first of all, Haji, virtual high five on the first one. Every advantage, perfect entry. Probably, no, that was the third divergence. You got it. Nice. Beautiful exit. Everything about it's beautiful. Really, I don't think I could have done this any better than you did. And then when we go to the next one, there's your reversal bar. And then when we look at the triggers, there's the top line and then there's the bottom line. And these triggers identify the correction point. Have you guys heard that lesson in class yet? The triggers identify the correction point. The area within gives it something to bounce off of. I say it a lot, but I don't think people always hear it. This is where I expect the market to correct to. But if I don't have something for it to bounce off inside of there, my advantage goes away. And Haji, I would rather see, just in my own trading, I would rather see an area 3 ticks above the correction point than 3 ticks below. Because I really don't expect the market to get out of this range. I expect it, if it's going to go from somewhere in the triggers, and then having something solid for it to bounce off of, one of those results of fear and greed, for it to skip off of, man, there's a huge advantage. And I see it a lot. When the entry area is beyond the triggers, it's less likely to work. And this was the NASDAQ as well. So when you get to the trigger lines, and I'm not sure what it looked like live, but your small triggers are pretty far away. They really are. So that's not really one of the issues that we're worried about, just being beyond the correction point. And then if it doesn't go from that mid band, stop's appropriate. You took a shot, right? You took a shot because the large chart said giddy up. I don't disagree with it, Haji, but I like to go through and I see the advantages and the disadvantages, and I kind of get on edge a little bit when my areas for continuation are beyond those triggers, beyond that correction point. And this is where sometimes I'll say, okay, I'll still go long with this look, but with this, give me a reversal bar, right? And then once it finally gets to where it tries to make them, those smalls are so close, give me a close on the correct side of the smalls. So I like the reads, both counts, good stuff. Except this one directly into termination conditions. Don't care for that one quite as much, but because it's from a good bottom, you were able to capitalize, which is nice. It's tight. It's a tight trade that you pulled off well. I'm telling you guys, it's fun watching you grow, and Haji, you're showing so much growth in your trading and your chart reading. And all I had to do was tell Miss Debbie that she's been awful quiet. Odds favorable, clear path, perfect entry as usual. And then you had quick profits. I love it. And as the area is breaking, but it's getting weak, you're like, you know what? I could have been out at the fib anyway. Let me put a stop there. If it just runs, I make a lot of money. But if it comes back, I'm still out of the right spot. I love this. I am notorious for that stop placement. That is one of my favorite ways to do it, Miss Debbie. I may have learned that from watching you. Nicely done. All right, was listening to gap theory and took the trade. What does that mean? Who was this? I've got to remember. This was Bob L. So Bob, what does gap theory have to do with this one? And I like that you put this in there. And I'm not entirely sure where your gap theory would have been. All right, so I'm going to show you what the gap theory is. And this would be one of those half-truths that we talk about. So Bob, the gap theory is a large chart thing first and foremost. The large chart It is 100%. On the small chart, this is a little fluctuation chart. And I've never actually utilized the gap theory on the small chart. But the large chart, when price reaches the mid-band and the large triggers are a full bar away, it's likely to pull back to those large triggers. It's likely to close that gap. On a small chart, it's not necessarily true. On a smaller, faster chart, it doesn't happen as often, but the gap theory is how we use for termination conditions. It's not an entry condition, really, because it's almost always going to be a bar away when you're on the wrong side. But it's the large chart that leads the way. So let's go back and look at what we see. The large chart has one out, one in. The large chart has a clear path. So you do have momentum and you do have a clear path. And your area was a little bit beyond the triggers. And we talked about this. I get a little nervous when it gets beyond, right? Because is it going to be this one or is it going to be that one? Who knows? But the large chart led the way. The large chart led the way. And because of the moves, because of the clear path, because of the momentum, you gave yourself the bounce point to go with the short. I don't disagree with the trade at all. But it's not the gap theory. The gap theory is a large chart phenomenon, if you will. Does that make sense? The only time I ever use the gap theory, Bob, is if you're trading the NASDAQ. I'll do something similar for a NASDAQ entry when the small triggers are a full bar away. But remember that the small chart on the NASDAQ is your large chart on the S&P. It's a 13.2. So that's the only entry chart where I'll incorporate that at all. A bar away always has to mean up or down, Rob, because they're going to go right no matter what. So a full bar away means that when it comes up and smacks something, whether it's a fib, a mid-band, whatever, if these large triggers are below that reversal bar marker, it just means that there's room for a full bar. This white bar right here, this white line, shows me where this becomes a reversal bar, which means that a full bar is going to print before it hits those triggers. So you'll see it, and let's go through and see a couple examples. Well, there's one pretty much right there. Hits the mid-band. Large triggers were essentially a full bar away, and it closes the gap back to those triggers. Let's see if we can find another one. Comes down mid-band, large triggers a full bar away, and it sucks it right back up to it. So this large chart is going to help you. See how it hits the fibs? Even though it's a great bottom, even though it's momentum, that gap theory keeps you from trying the long too soon. And guys, this is one of the greatest reasons why annotating your charts is so important, because we just got a cool lesson on the gap theory. Thank you, Bob. I love your trades though, because, and let's go back to the slide ruler. I don't know why I call it the slide ruler. Is you didn't have the entry area, right? One thing missing. But you did have momentum, and you did have a clear path. So you said to yourself, with 66% of my advantages, I'm going to trade something solid, and I'll manage aggressively. I love the trade, Bob. I think you killed it. And a misunderstanding of the gap theory didn't affect you at all because you let the large chart lead the way. If anything, it gave you the confidence to take a great trade that maybe you might not have otherwise taken. All right, scrolling up, and I'm going to remember whose chart it is this time. Andy, that was your three divergences. We won't click on that one. All right, Dwight. Dwight, odds favorable. Clear path. Area inside of favorable large triggers. Got stopped out. How do you feel about this one, Dwight? Here's the big question. I feel great about it. Guys, this is what we call acceptable losses. This is, well, I was referring to the one with the three divergences, Andy. That's what it was. That's why I didn't click on that one. Because we went through and we got that lesson and you nailed it because crude went down right from that spot. Guys, I think this is an important part for all of you new users to recognize. Dwight had odds favorable momentum, and Dwight had a clear path, and he had an area inside of favorable large triggers, and his stop was appropriate, and he still took a loss. In anything that wins, yeah, I haven't gotten there yet, Andy. 70 to 80% of the time must lose 20 to 30% of the time. And just what Ron said, it's a cost of doing business. Acceptable losses. Normal part of trading. Yeah, the timing is everything, right, Rob? So guys, this is every advantage. This is the perfect trade, and this is an example that we're not in charge. The only thing that we're in charge of is whether or not our rules are met, and Dwight's were met perfectly. And they were actually met so well that I'm going to go to my favorite looks, and I'm going to drop this one in there. And I'm going to say, rules met long. Didn't work, but we'll take again. Because even though it didn't work, that is my look, guys, 100%. This is the look that's going to get me into the market. That is all the advantages, the perfect entry, absolutely nothing wrong with this trade. It's just a cost of doing business. And for the new user, you start trying to figure out what went wrong. You start wondering if one divergence killed the trade. You start wondering if small triggers against you killed the trade. When the reality is it was just a great trade that didn't work. So Dwight, thank you for posting that. And posting losers, guys, that's where it's at. There's nothing worse than being upset about a loser and then finding out that you did everything right and it's just a cost of doing business. Or maybe there's nothing better than it. All right, Jen, let's see what you did. I mentioned to share all charts, so posting this messy triggers, so being patient. I love it. One is down, one is up. Great job not taking the short, right? 50-50. Strong triggers, divergence kills it. Keep posting them. But tell me what you see, right? Always post your messy charts, but tell me why it's messy, right? Background's red, triggers are green. That's not the best. Straddling fibs, that's not the best. Divergence, that's not the best. Bad top into a mid-band, holy crap, that's not the best. Right? So it's not just for me, Jen, it's also for you. Because if you take this picture and you say the colors don't match, it's not a clear path, what you're doing is you're reinforcing that this is a wonderful time to be patient, that this is such a great time. You could also point out the gap theory right here where price hit the mid-band and the large triggers didn't follow, right? Post your losers, Rob. So Jen, great picture. Keep them coming. Like post all of them. Every chart is a lesson. Every chart is a lesson. Every winner's a lesson. Every loser's a lesson. And then Rob, Ron, you got unsquished, right? Let me go through a quick little scaling thing, guys. If your chart, oh, that's not what I wanted to do. When you look at your charts, if they're super tight like this, somehow, click F. It'll bring them back. If you can't see the most current bar, click an arrow. If you need to see what's above you, grab and drag down, right? And guys, you don't need to see this much of the market to understand what's going on the most current bar. Make it readable. Make it legible. My apologies that I didn't see that at 10. And sometimes I'll miss things. That's all right. Brain farts happen. All right. 1-to-1. Support did not trade because we were at, so it was a 50-50 on resistance, right? So these were 1-to-1s. He didn't take the messy. This is where I start looking for those longs, Jen. This is where that 50-50 off the good bottom, that's where I start looking. What happened after it? Because you notice that it's a good bottom and then a higher divergence. The mid-band is a termination. Another mid-band termination. Support holds, triggers don't bounce. Do you see how all the indications were up and the momentum was crazy and you got above the divergence high? And there's no divergent strong triggers in the smallest entry ever. I like this entry right here, Jen, because of the accumulation. Good bottom, overwhelming momentum, potential to break, no divergence, strong triggers, and your window of opportunity is like 2 lines wide. Does that make sense? And what's happening right now is there's this phenomenon where you start off and you want all of the trades. And then you realize that you break your rules a little bit, and then you talk yourself out of all of the trades. You convince yourself that there's something wrong with every look. I'm so guilty of that. So guilty of that as a brand new trader. So keep it simple and keep your reads focused, right? Where am I coming from? What does my momentum say? Do I have the potential to break? And if I do, I'm looking for that no divergence. I'm looking for that easy entry, right? Take it. Take that trade, and you don't hit trouble until $300 worth of profit later. Does that make sense, Jen? You'll go from trying to catch every move to avoiding every move. And then it balance out, guys. It's like finding religion. And I hope that's not offensive to anybody, but it's like finding religion. When you first find it, you swing hard to the right, and you want everybody to join you. And you're aggressively soliciting. And then you kind of even out and you develop your relationship, right? So you're developing your relationship with the market right now, Jen. And with that look of momentum, and then the lower, you said, you know what? I'm not taking it. The smalls are against me. And then you get odds favorable down. And that's your first shot, right? Into the mid-band, large triggers aren't a full bar away. Waiting for it to at least come back to a correction point is brilliant. And as it goes down, there's your second one. And you're looking for 18.092.87. Absolutely beautiful. Absolutely beautiful. Momentum leads the way. Potential to break. No divergence. And I want you to see something. Hey, Jen, watch this. Do you see the momentum? Potential to break on the one-to-ones? Here, respectfully, you were a bit chicken shit. And you refused to take it. Going down with gravity on your side, you couldn't wait to take it. It's the exact same look at the exact same one-to-ones, isn't it? And that's a phenomenon that I can't explain. Is you'll talk yourself out of one, and you'll take the exact same look. And actually, I think your first trade was a better look. And I can't for any reason find the rhyme or reason in it why we do that. I am hesitant to take momentum trades short. I don't know why, but I'll take them long all day long. And I don't know why. Bugger. I heard that in your accent too. You're Aussie? Well, that's good because my English accent sounds Australian, so that worked out perfect. I mispronounced it, and I got it right. All right, Gino. Odds favorable. Heck yeah. Clear path. Heck yeah. Gino, are you in here, brother? First of all, great job on the large chart. That's your area that's inside the triggers. You're a little low on this one, just a little bit low. And that may have been intentional. But because they're split, that's the one with the lines inside of it. I love it. Great stop placement. Small triggers. Bob, this is where on the NASDAQ I use that gap theory idea for entries. Out at trouble. Beautiful. Gino, everything about this trade makes my heart smile. Was it pretty easy? Like when you took it, you're like, man, that's so much momentum. Sure. Why not? Whatever, Mark. That's cool. It's a great trade. Clear path pays dividends, I think. Really does. Clear path makes it so much easier. When you couple that with momentum, life gets good. Mark, the fast triggers are above price. Can you talk about this, please, in terms of momentum and good triggers, clear path? You're darn right I will. I love when you guys post like this in the room. When you guys say, hey, you know what, Mark, can we have a lesson on momentum? All right, so let's do this. We're going to start with small triggers, Jen. And I'm going to draw a line on the small triggers. Do you see how the bars are outside of the small triggers? That is the momentum phase on both your large and your small triggers. But you're going to see it on the small triggers first. You see it here as well, right? You're on the momentum phase. Are you comfortable with that phrase? When the bars are outside. So what happens is this momentum phase is absolutely amazing for those little quick hits that you see people take on the way down, or those little quick hits that you see people take on the way up. But what's pretty amazing is when you come back inside, you're no longer in that momentum phase, right? So maybe a quick hit and then a quick hit and maybe another one. And then we get to the other side of the small and you're like, hey, wait a minute. I don't have that immediate momentum anymore. Is everybody following me so far? So Jim, the second half is here's your large triggers. Do you see how you're in the momentum phase on the large triggers? And when we are in momentum phase on the large triggers, hold on, let me find the picture. Dun, dun, dun. I've got a bajillion pictures, and these are all scrambled from stuff that I was doing with my brother. So hold on just one second. When we are in momentum phase on the large triggers, this is your high probability trend trade, guys. This is that pullback that we look for. The small triggers will be outside, but we're looking at that momentum phase on the large triggers. So what you've identified, Jen, is that yes, we are no longer in the momentum phase on the small indicator, but we are very much in that high probability trend trade look. So bars outside of the triggers, and it's the same thing here, right? That pullback is on the wrong side of the smalls, but it's in the perfect momentum phase on the long. Same one here. And as it begins to slow down, we get that little hitch, and then it comes back down. Yeah, Ron, have a good one, man. Slow market days are no fun. Jen, thank you for that picture. That's a great lesson. And I think I dropped the momentum phase picture in the room, guys. And the momentum phase is true, no matter what chart you're looking at, no matter what it is. And when you're in that phase, it's easier. And then that's it right there, right? Super strong. Absolutely nailed the pullback to support inside of the triggers. You got paid before the first bar even printed, or maybe right on the second bar. Absolutely beautiful, Gino. Nice trade. And great management, right? It's a 50-50, and it has a divergence, but with all the strength you took it anyway, but you said, you know what? I'm not going to sit and hope because it's not high probability. Beautiful. And it is You can't see the bottom, but it looks like it is a weak bottom because it's not a no triggers through termination. Great management, Gino. It's okay to not have them all home runs, right? All right, Jen. Oh, we saw this one. Did you mean to post it again? No, it's okay. Don't be sorry. I just wanted to make sure that there wasn't a follow-up question to it. All right, Rob. It looks like you have a few pictures in here. Guys, if you ever post multiples and I miss one or two, make sure you let me know, please. Let me make it a little smaller. I was blown up for Gino. All right, got in at 81.89. Clear path, momentum in the way. Got out when you had 200 profits, was scared. At 82.19. So you were going long over here, Rob? I just want to make sure I'm reading this right. Okay, so that was there for the window of opportunity. But that was directly into a mid-band. That was a 50-50. That was gap theory. So I'm glad you didn't go short. Split triggers, right? Do you see the gap theory on it, Rob? When you hit that mid-band and those large triggers were so far away, cool. And then when it doesn't break and it goes up, you get a 50-50 to the upside. You get no divergence, strong triggers, perfect entry, nothing but money. Rob, solid. 100% solid. That's the same picture. All right, odds favorable, clear path, pulls back to support, inside of favorable large triggers. Two divergences didn't scare you, and the market goes up with all that momentum. You were scared. Where were you scared? On this one? It's okay to be scared. Are you upset about $200 though? Never, right? And then this one, the two divergences made you a little nervous, right? But so, Rob, how many divergences does it take to kill that uptrend, to become a termination condition? 3. The first one gave you an entry. The second one said, oh shit, we might have missed Rob. Let's go back and get him. And then it headed off and did what it was doing, 230. Absolutely beautiful. Rob, you have taken it and put it together. Nicely done. Right here? Is that the one you're talking about, Bob? No gap. There is no gap there. That's just strong triggers to the upside. So Bob, when it hits the mid-band and these are a full bar away, that's the gap. Up here, don't even look at the small chart. A little bit. So let's do this. Thank you for pointing that out. All right. Make it to where I can blow this up a little bit. I want you guys to see this. So there is a little bit of a split. So from the top of the triggers to the bottom of the triggers, right? Watch how cool this gets, Bob. There's my highest point of support. There's my lowest point of support. You have to be willing to miss it if for some reason it goes without you. But that's why it's so important to look for the triggers and then the areas. I know that I'm looking from the top to the bottom. They're a little split for sure, but I've got beautiful stacked areas right inside of the synthetics. So whether it goes from here or whether it goes from here, I still know exactly where my stop needs to go. It's what gets me, and let's see if we can find an example, is when they're split, and let's just say hypothetically because it's NASDAQ, and I'm looking at my trigger lines, and when they're split, whoops, it can go from there all the way to there, right? But if there's no areas down here inside of triggers, well, then I still only have one area inside. I just have to be patient for it to get there. Good stuff. Great lessons, guys. Great lessons. Nice trading, Rob. And trades get easier to hold the more times you take them. Management's terrifying in the beginning. Eek! Your opinion is what caused you to enter this trade. I love that you wrote that. Dwight, I absolutely adore the fact that you wrote that. But I'm not going to lie to you. And I said it when we were losing this one on simulator, breaking our rules. Is Dwight, when I have this look and everything is below all of these fibs and both of my triggers are red and there's no divergence and I've got this tiny little window, I'm not going to lie. You had 99 things saying that market was probably going down and you had no momentum and that was it. So it is an opinion, right? It's a rules broken trade. Dwight, I would say that's a calculated risk. I would say that is a calculated risk if you were going to take it because of the divergence above you, because of the fact that all the triggers continued down. And really the expectation of this divergence is to take out that previous pivot. And I'm surprised that it didn't. I was surprised that this one lost. So while it wasn't rules-based, it certainly had more advantages than disadvantages. And if you're going to take those, then you got to be cool with it, right? But was your thought process anything like mine? Termination, triggers didn't blink, everything was red, no divergence, little window. The only thing that I might have done is gotten that stop where the market shouldn't go and not given away so much. On which chart? They're going to remain down no matter what. Large triggers don't roll that fast. Oh, on the pullback here? Yeah, I pulled all the way up to resistance, and these things never even blinked, right? Yeah, Dwight, don't beat yourself up about that one. That was a great chart read. You forfeited one advantage. It's a medium probability, so it's not going to win 70 to 80% of the time. I'm not going to lie to you, Dwight. I probably would have lost that trade with you and not felt bad about it. Not even a little bit. Because it had appeared that the market had already consolidated, and that divergence and everything down and that not blinking, dude, do not beat yourself up about that trade. They can't all work, right? And some days, fewer work than we wish. Ace says rules not met. Let's see what he did. Example of rules not met. I love when people put that in the class. So on the large chart, directly into a termination with odds favorable, and it just didn't work out, right? But you held it anyway. That's what's scary. Ace. And that's it. It's either rules or not. Ace is like 3 divergences, F them. Termination condition, F them. Way beyond the window of opportunity, kiss my ass, crude oil. I will you to the upside. And it worked. And every now and then, man, the trading gods smile on you and you get out of it with a point or two when everything said that you were on your way to a loss. So I love that you know that you broke your rules, and I'm happy that you came out on the right side of it. Not a lot of classes are going to use the phrase F 'em, so I apologize if that bugs anybody. All right, Andy. Odds favorable, 50-50. How many divergences can we give it before we say uncle? How many divergences on a 50-50 are too many? All right, Andy. Odds favorable, 50-50, good bottom. You took this on sim because you didn't want to break your rules. Andy, didn't you break your rules? Here's a huge lesson. Sim doesn't know if you broke your rules or not. What are you telling yourself when you take these trades? And this isn't just for Andy. What you're saying is that it's okay to break rules because it's simulator. The same reason that you'll break rules on simulator. And Andy, if you had gotten paid on this trade, you're more likely to take it on your live account. Guys, this is muscle memory. And now it's story time. Andy did this to you, so... And a lot of you have heard this one, but when I was younger and probably better looking, I used to road race motorcycles. I used to put on the leathers and go 120 miles an hour and drag knees and all that fun stuff that you do when you're flexible and young. And I was out on a practice session before an endurance race, and I was going at about 60%. About 60%. I was out there. I was suited up. I was going fast, but not my fastest. And a buddy of mine blew by me, looked over his shoulder, and gave me that same FM look. And he came to me in the pits, and he said, "What the hell are you doing out there, Mark?" And I said, "Man, it's just practice. It doesn't matter, right? It's just practice. It doesn't matter." No, bad genetics, Bob. I've got degenerative disc disease. But what his point was, Andy, and what I really want you guys to take to heart, is that what you're doing is you're training your brain. You're training your brain how to perform when it's real. And your brain doesn't know that two divergences on a 50-50 with no areas inside of favorable large triggers, they don't know that you're being silly, that you're breaking all the rules, that you're virtually eliminating your chances of success and just hoping that it gets lucky because it's fun on simulator. And if you're not at the point in your trading career where you do things automated, where you do things without thinking, where you follow your rules without hesitation, guys, this is going to set you back. This is going to set you back weeks and months of study. That's going to set you back every time. Because one of the first things that I say every day is don't practice the wrong trades. Don't convince your brain that it's okay to take the wrong trades, because what happens is you get these little short-term victories that are a lot of fun, but you get this long-term failure because one day this is your live market and you're like, hey, remember when I won on simulator because my balls were overflowing from my chair because there was no real risk? Or ovaries, I suppose, ladies. Excuse me if I'm being crass. But guys, that's the kiss of death. And Andy, I'm not trying to harp on it. But man, practice like you want to play, guys. It's one of the greatest lessons I ever got. Practice like you want to play so that when the chips are down, you play with aggression. You play with confidence. Not a strong bottom. All right, Jen. So let's go through it. I love it, though. Love everything about it. Not a strong bottom. So for this to be a strong bottom, what has to happen is it has to go up, and then it has to retest and turn that divergence low into a termination condition, and then go back up. Does that make sense? What we do have a pivot stop out. But since the triggers got through it, we can't call it strong. It's still a termination condition. And it still reversed the market, but it's not a no triggers through termination. So we don't give it that name. We save that name for the best of the best because it creates an advantage. But what you do have is a market screaming to the upside with the potential to break. And it's not just barely breaking, it is screaming with anger. One divergence and you're like, I'm in, right? And everything continues and nothing blinks. And you're like, I'm going to get some more. And then it pulls back again and you're like, oh my gosh, let me keep making money. Rob, the RTY moves pretty good. Sometimes the S&P. And once you get your chart reads down, I love my afternoons in the NASDAQ. But you got to be really good at what you're looking for. So yeah, RTY might be a good one. Gold might even be a good one. I'm not sure how that moves, but I know Paul trades it a lot, and he really enjoys it. So Jen, great trading, great recognition, and I hope me saying that it isn't a strong bottom doesn't hurt your feelings. It's just a little language thing, because what happens is when we have a strong bottom or a strong top, it really, really increases the likelihood of success on those 50-50s. All right, let's see what we got. Zorro, I bet you it's a momentum trade. So watch this. Zorro, you didn't annotate. You didn't show me entries or exits. Are you with me in here? And I want to know if, let me know if I get it right. Zorro says, everything is absolutely screaming to the upside with the best momentum ever. Going to let the area break and get out somewhere up here. Does that sound, am I close? Somewhere from here to here, I would say, based on this momentum. And I'm just curious, you didn't annotate, but this is the type of trading that I've seen from you already. The entry was lower, so you got in on the pullback to support down here? Or did you get in? Okay, I love that one too. No divergence, perfect entry. So I love this entry. I just assumed it was that one because that's kind of what you've been showing me. Both are beautiful, both momentum for the win. Rockstar, Zorro. I'm assuming you've traded before. I'm assuming this isn't your first introduction to watching the markets, maybe. You never have. This is first? I guess no bad habits, huh? Momentum for the win. You seem to really be embracing the idea that momentum carries a market, and you're doing it wonderfully. I can't wait to see you in 6 months. Andy, NASDAQ troubles aren't any different than crude oil troubles. NASDAQ troubles aren't any more different than crude oil troubles. NASDAQ troubles aren't any different than S&P troubles or gold troubles. If you don't have momentum or a clear path, it's harder to find a win. If you start throwing your advantages out the window, it's harder for a win. The only thing that's different on the NASDAQ is that one little level of patience where you don't fight those small triggers. But if you don't respect termination conditions, the NASDAQ will kill you. If you don't respect losing momentum, the NASDAQ will kill you. And then once you realize that when the NASDAQ says up with strength and the small triggers are a full bar away, you're just going to get in at the area automatically and you're going to ride that wave of momentum up. And it becomes effortless. But if you were hoping that this would break on the NASDAQ because of the momentum, you got your ass kicked. And if you were hoping that this 50-50 was going to go down because that was a good top on the NASDAQ, you got your ass kicked. So it's all adherence to rules, guys. It's all adherence to rules 100%. Learn it on the easy charts. Learn it on the easy markets, and then go jump into the NASDAQ later on simulator, right? Don't be like me. Don't blow out 10 accounts trying to learn how to be a NASDAQ trader. There's no reason. All right, JW, bad bottom, terminations, gap theory, and you go long anyway with giant split triggers and divergence directly from the fib, and they reward you with a win. Whew. Why were you looking to go to the mid-band? Because that's a key point here. Why were you thinking mid-band? Why were you willing to put that risk on? And guys, this is a pattern. He didn't name it. I know exactly what he thought, but I've got to point out all the holy shnikes moments. Divergence and weak triggers from the middle of nowhere typically hits a mid-band. Weak triggers, divergence prints, typically hits a mid-band. That's a pattern. JW, nicely done. Hey guys, this is what's fun. This is the stuff, and I'll tell you right now, I used to take a short right here while my brother was teaching class, telling everyone that it was likely to go to the mid-band. I was getting run over while he was discussing the pattern, and it happens a lot. And you're still in the momentum phase on the small triggers, which increases the likelihood. And your large triggers are up, and your small triggers are up, which increases the likelihood. JW, it's a great trade. But if you're not in tune with all of your rules being met, if you're not in tune with the patterns, it looks like suicide. It really does. 2 trades, momentum on the last. Looks like first trade was going against you. Got out. So your first trade was a 50-50 from the wrong side of triggers. What made it look like it was going against you? You got to the correct side of the triggers. You made it through the hard part. This is a good one just as you grow in management. Don't say look like it was going against me, because it didn't. You got to the other side. You killed the momentum phase up. You got to the short side. Your large and synthetics are still down. You do have momentum. You got in against everything, and then once it got easy, you exited. And that's a good annotation to put on the chart. I exited when it got easy. A more appropriate one would have been when divergence printed to exit the trade, because then there was a reason, not you got through all the hard stuff. And then over here we had that odds favorable clear path, absolutely beautiful entry. You took quick profits, nicely done. All right, I'm going to show you a neat phenomenon, Bob. There's the small triggers up. You entered on the momentum phase against them, right? So it didn't bother you so much to get into the trade. I don't know why. That's you'll have to think about that. And now we're on the business end of the short side, right? We've killed the momentum phase. The bars have come through. All of the triggers are below resistance. You really let it do all the hard stuff. You got in when it was a little difficult. And then once you get to the other side, life gets a little easier. And it'll take a while to feel comfortable with that one. But I noticed that you didn't have divergence on the pull up, which is great, right? Because if you're going to play the 50-50 card, no divergence is huge. I like your trade. And you traded from resistance that was likely to hold. I love your trade. Unless where you circled is not where you entered. 1029. Nope, you didn't. All right. So, Bob, you got me looking at this one with the circle. 1029 is where you went short. Off the termination condition, the higher divergence with everything flat, smalls on the wrong side. So that wasn't a short at all. That was a hoping it would go down. And then the long I love. But all the stuff off to the left has nothing to do with it. This entry was right about here. So I think what happened is you know that you broke your rules and you jumped ship hoping to not get run over because you knew that it was a termination with divergence and that the smalls were above the large and that the large were flat and lifeless. And you said, oh crap, I may have gotten away with one. Let me get the hell out of this trade, which is okay. Because sometimes we enter trades and go, whoa, that's not my best look. Let me see if I can get paid, get out, and then let me turn around and take the one I know that's more likely to win. And you did that beautifully. But you see the large chart look getting in? And I've done it. I told my wife that yesterday, Bob. I was talking to her and I was like, man, I took this trade yesterday and I realized that I had misread my large chart. And I'd misread my large chart. And it happens. Even someone that reads well, you get caught up in the moment and you make a mistake. I'm whittling this down for you. And this is one of the things that my brother got me thinking about a lot. And granted, this is pretty small. But just based on that look, is that your best look for a short? And I ask myself this a lot now. Is this my best look for a short? And it doesn't mean that there isn't a short necessarily. But a lot of times if I find myself thinking longer than I should be on a trade, like if it doesn't take me 3 seconds to say, yes, this is my trade, then I have to look at my large chart real quick and say, is that my best look for a short? Because what happens is I make mistakes. So NASDAQ, termination, full reversal, hit the mid band, large triggers are a full bar away. Is a short trade from this mid band my best look for a short? There's your gap theory. Does it mean it won't go down? Of course not. But it means that there's a pattern in place that says very often price is going to come up and close that gap to the large triggers, which means that if I go short at the mid band, it's less likely to work, which means that if I fight these small triggers, it's less likely to work. Do you guys see how that just worked? So NASDAQ traders don't fight small triggers. All traders not fighting gap theory. And you have to be okay saying it's just not my money. If for some reason it goes down from here, it just wasn't mine. Andy, 50-50, 2 divergences, 1 divergence. Andy, it's a great looking 50-50, and you don't have an ATM strategy in place. That's why. On this particular trade, Andy, you don't have any stops and targets in place. So let me show you how to fix that. Do you guys know how to fix that? If I don't have anything in place and I go short for some reason, I'm not saying this is a trade, I don't have stops and I don't have targets. So the opposite of short, I have to right click and put buy stop market. And then for my profits, the opposite of sell is buy. I'm going to put buy limit 2. And I have to put these in. Because your large chart had an ATM strategy in place, this one didn't. So if it hits my target or my stop, well, that didn't work. There we go. I have to cancel out the other side. So Andy, your large chart probably had, well, actually your large chart didn't either. It's not even showing it. So your large chart isn't even on your take profit. Or you would see it over here. So your large chart was probably still on sim. You put this one on take profit, but you forgot to set up your ATM strategy. So when that happens, you either have to get close and get out, or you have to use the opposite. So if you buy, you need sells to even out. If you sell, you need buys. That's a good one to practice on simulator. And then the key is you've got to remember to cancel out. All right, Miss Debbie, odds favorable, clear path, perfect entry, you get paid as you do. That's pretty much the same feedback I put on the other one, Debbie. Odds favorable, clear path, perfect entry, you get paid. That seems to be your MO these days. Waiting for advantages, taking those advantages, enjoying life. And then again, Zorro, you're not giving me anything to work with. So watch this. Zorro, oh, there it is. I do see it. Never mind. Never mind. I do see it. I got it hidden in there. There's that John Novak up-down pattern. Not from a good top. Momentum phase. You let the synthetics clear, so you got in up here before trouble. And down it goes. Nice. That took me a second to see that. It was kind of hidden behind all your triggers. Good luck. Momentum for the win, guys. Momentum phase for the win. We see that a lot in here. Have you guys noticed that? There's a lot of momentum phase for the win. And Jen, I think next time I want to see you say termination. Not a strong bottom. Termination. 50-50 failed with momentum, with divergence. Odds favorable, clear path. Maybe put a damn right I bought that mid-band. Beautiful trade. And then you get out on the second divergence. God, Jen, beautiful. Momentum. Perfect entry. Absolutely stunning exit. She waited for a second divergence to get out of it. No, Jan, you're not allowed to ask what the blue arrows are. Sorry. When you purchase software, that was part of the contractual obligation, was never ask about the blue arrows. No, just kidding. They are, notice how they correspond with the triggers rolling. And I don't know why it only shows it on the up. So check it out. If I right click and go to indicators, go to T3 trigger lines, and then I'm going to take the picture for you. I love that you guys jaw now. That cracks me up. Where is it? Right there where it says draw arrows, make sure that it's unchecked. And that'll get rid of those. It'll recalculate the chart for you. I just think they're a distraction, to be honest with you. There's the picture for you. So if anyone else has those. It was something that John had when he was rewriting the templates. And when he was rewriting the templates, those were something that he was working on, and they worked their way into it. But they're easy to make go away. And then you broke the rules. Fought momentum. Zorro, I love that you know that you broke the rules. 50-50, divergence prints. Try to get that quick one, right? I like it. Zorro, can I give you a cool little, and this is for everybody that's using those range charts. I know that you're a week into it. One of the biggest things that I see is if these fast triggers are down, it's always easier trading from the correct side of them. See how strong they are down? Hey, Jazz, thanks for being here. I know it's a lot on day one. Tomorrow will seem easier, and every day after. I'm excited to have you here. Zorro, this is a good one. Once you get to the correct side of those faster triggers, life gets easy. So if you ever notice that they're against you, I love the termination, the divergence. I love the thought process. Get to the correct side and you'll have a better chance of catching that move up. Just a little chart reading thing. Gary exemplifies it. Mid-band, and I'm not sure, you go short with the momentum on the correct side and you take your exits, and then when everything rolls, see how he gets that white one that rolls there, Zorro? And he enters on the correct side of it. And it helps him take advantage of it. So his large chart says mid-band may hold, may not. There's a lot of momentum against it. You can see that he's in on the correct side of stuff. It's a little aggressive because he's coming off a pivot stop out and then resistance that holds and odds favorable momentum and everything says down. Gary, I'm not sure you had a reason to go long just yet into those synthetics. I'd be looking for the short, to be honest with you. But I'm glad you won. I'm not sure that look from a double termination pushing down with odds favorable. I'm not sure that one's going to get you the best seat in the old folks' home when you retire. Man, you guys kept me busy today. Let's go see what the live market's doing. That's all the pictures. Yeah, but the range chart can't lead the way. And actually, let me rephrase that. Gary, you can do whatever you want. You can do whatever you want. The range chart is not a magic leprechaun that makes wonderful things happen when you fight odds favorable momentum. You don't even have a termination condition. You have a pivot stop out with no triggers through. Everything came down, pulled back to resistance, and the triggers didn't blink. And you had odds favorable momentum to the downside. And you had an area of resistance inside of favorable large triggers with odds favorable to the downside. And if you're going to let these trigger lines roll, get you into a trade, why didn't you go long there? Why didn't you go short here? Right? And guys, I know you hate it when I use logic. If you're saying that's your reason for a long, then you should have been long there, right? Over here at the mid-band. And you definitely should have been short here. And short here. And here you got short. No, here you got short with the small triggers up. But you got short with momentum down from a termination condition. So, guys, it's got to be consistency. Man, Andy, thanks for being here getting lessons. I really do enjoy it, but it's fun. It's fun to watch you guys grow. So how'd we do today? Did you guys learn anything? Did it get a little bit easier for anybody? I hope so.